Somewhere, in the depth of the night, in the quiet hours when the world seems to pause, a single line of text was written into a block of code. It was January 3rd, 2009. The message read, "The Times, 03/Jan/2009, Chancellor on brink of second bailout for banks." This was not just a timestamp. It was a declaration, a quiet rebellion, a message embedded in the very foundation of something the world had never seen before. That something was Bitcoin. And the question we ask tonight together as we drift through this story is why? Why did Bitcoin begin during one of the greatest financial catastrophes in human history? What forces, what fears, what dreams converged to create a currency that lived not in vaults or central banks, but in mathematics, in code, in the invisible architecture of trust itself? Tonight, we will journey together through the collapse of empires made of paper and promises. We will meet the cryptographers who believed that privacy was not a privilege, but a right encoded in the very fabric of the internet. We will stand at the edge of a precipice in September 2008, when Lehman Brothers, a titan of finance that had survived wars and depressions, finally fell. And we will understand how that fall, that single moment of reckoning, became the seed from which a new kind of money would grow. But this is not a story of technology alone. It is a story of human fear, of distrust, of the ancient desire to take back control from those who claim to guard our wealth, but instead gambled it away. It is a story about belief, and what happens when belief in the old systems shatters like glass. Let us begin, not with Bitcoin, but with the world that made Bitcoin necessary. Picture, if you will, the year 2007. The global economy was a cathedral built on sand. Houses were being bought and sold at prices that defied gravity. Mortgages were being written for people who could never repay them, and these mortgages were then bundled, sliced, repackaged and sold again as complex financial instruments with names like collateralized debt obligations and mortgage-backed securities. The genius of Wall Street had created a machine that could turn risk into profit, or so they believed. Banks were lending to anyone with a pulse, and why not? Housing prices, the wisdom went, only ever went up. It was a faith as old as finance itself, the belief that this time would be different, that the rules of gravity and consequence had been suspended by innovation and sophistication. But gravity, as it always does, reasserted itself. In the summer of 2007, the first cracks began to show. Subprime mortgages, those loans given to borrowers with poor credit, began to default. When people could not pay their mortgages, the value of those mortgage-backed securities began to crumble. And because these securities were held by banks, investment firms, pension funds and institutions across the globe, the contagion spread. Bear Stearns, one of the oldest investment banks on Wall Street, saw two of its hedge funds collapse in July 2007. The funds had been heavily invested in subprime mortgages. The losses were catastrophic, and though the firm tried to contain the damage, the wound was mortal. By March 2008, Bear Stearns was on the brink of collapse. The Federal Reserve, fearing a domino effect, engineered a rescue. J. Morgan Chase bought Bear Stearns for a pittance, $2 a share, later raised to $10. The government guaranteed $30 billion in potentially toxic assets to make the deal happen. It was a bailout, though no one wanted to use that word yet. For a moment, the world exhaled. The crisis, it seemed, had been contained, but beneath the surface the rot was spreading. Lehman Brothers, another pillar of Wall Street, was drowning in bad debt. Throughout the summer of 2008, the firm tried desperately to find a buyer, to raise capital, to convince the world that it was solvent. But the numbers did not lie. Lehman had over $600 billion in assets and more than $600 billion in debt. Its balance sheet was a house of cards. On the weekend of September the 13th, 2008, the Treasury Secretary Hank Paulson and the President of the New York Federal Reserve, Tim Geithner, convened an emergency meeting. They brought together the CEOs of the biggest banks in America, Goldman Sachs, Morgan Stanley, Citigroup, Bank of America, and asked them to save Lehman Brothers. The bankers, many of whom were fighting their own fires, refused. They knew that Lehman was too far gone, and so on Monday, September 15th, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. The world shuddered. The Dow Jones Industrial Average fell more than 500 points in a single day, the worst drop since the attacks of September 11th, 2001. But the real panic was happening in places the public could not see. The interbank lending market, the invisible circulatory system that keeps the global financial system alive, seized up. Banks stopped trusting each other. If Lehman could fall, anyone could fall. Money market funds, which millions of people considered as safe as savings accounts, began to break the buck, meaning they could no longer guarantee that $1 invested was worth $1 returned. In the days that followed, the government scrambled to contain the crisis. The Federal Reserve took over American International Group, AIG, with $85 billion in emergency funding. Without AIG, the entire insurance and derivatives market would have collapsed. The government extended deposit insurance to money market accounts. Congress, after initial resistance, passed a $700 billion bailout package, the Troubled Asset Relief Program, known as TARP. It was the largest government intervention in the economy since the Great Depression, and still the damage was done. People lost their homes, unemployment soared to nearly 10%, retirement accounts evaporated, the gross domestic product of the United States fell by trillions of dollars, and the fury, the deep and abiding anger that spread through the public was directed at the banks. The same institutions that had gambled recklessly with other people's money were now being saved with taxpayer dollars. Bankers who had earned millions in bonuses were walking away unscathed while ordinary people lost everything. The phrase "too big to fail" entered the lexicon, a bitter acknowledgement that some institutions had grown so large, so interconnected, that their collapse would bring down the entire system. It was a kind of financial feudalism. The rules, it seemed, applied to everyone except those at the top. This was the world into which Bitcoin was born. Not in a boardroom or a government office, but in the mind of someone, or perhaps a group of someone's, who'd been watching the crisis unfold and had come to a singular conclusion. The system was broken, and it could not be fixed from within. To understand Bitcoin, we must first understand the ideas that preceded it. We must go back further, to the late 1980s and early 1990s, to a movement that called itself the Cypherpunks. The name was a play on cyberpunk, the science fiction genre that imagined dystopian futures dominated by corporations and surveillance states. But the cypherpunks were not writing fiction. They were writing code. They believed that the rise of the internet and digital communication would bring with it an unprecedented threat to privacy. Governments and corporations would be able to monitor every transaction, every conversation, every movement. And the only defense against this surveillance, they believed, was cryptography. Strong cryptography. Unbreakable codes that could protect the individual against the power of the state. The cypherpunk movement emerged from a series of informal meetings in the San Francisco Bay Area. Among its early members were figures like Tim May, a former Intel physicist who wrote the crypto-anarchist manifesto, Eric Hughes, who penned the Cypherpunk manifesto, and Phil Zimmermann, who created PGP, Pretty Good Privacy, one of the first widely available encryption programs for email. These were not radicals in the traditional sense. They were engineers, mathematicians, computer scientists. But they shared a libertarian ethos, a belief that individuals should have the tools to protect themselves from overreach, whether by governments or corporations. In 1993, Eric Hughes wrote, "Privacy is necessary for an open society in the electronic age. We cannot expect governments, corporations, or other large faceless organizations to grant us privacy. We must defend it ourselves." And the tool they chose for that defense was cryptography. Cryptography, the art and science of encoding information, has a long history. For centuries, it was the domain of militaries and spies. During World War II, the Allies' ability to break the German Enigma code gave them a decisive advantage. But cryptography remained largely inaccessible to ordinary people. That began to change in the 1970s with the invention of public key cryptography. In 1976, two researchers, Whitfield Diffie and Martin Hellman, published a paper called New Directions in Cryptography. It introduced a revolutionary idea. Instead of requiring two parties to share a secret key in advance, which was risky and impractical, public key cryptography used two keys: a public key, which anyone could see and use to encrypt a message, and a private key, which only the recipient possessed and could use to decrypt the message. It was elegant, powerful, and it changed everything. A year later, in 1977, three researchers at MIT, Ron Rivest, Adi Shamir, and Leonard Adelman, developed a practical implementation of public key cryptography. They called it RSA, after their initials. RSA became the foundation of secure communication on the Internet. When you visit a website with a padlock icon, when you send an encrypted email, you are using the principles of public key cryptography. But in the 1980s and 90s, the US government considered strong encryption to be a munition, a weapon of war. It was illegal to export encryption software without a license. The government wanted to maintain control over cryptography to ensure that it could always decrypt communications if necessary. The cypherpunks saw this as tyranny. They believed that privacy was a fundamental human right and that individuals should have access to the same cryptographic tools as governments. And so they began to write and distribute encryption software, often in defiance of the law. One of the most famous battles in the crypto wars, as this struggle came to be known, was over PGP. Phil Zimmermann released PGP in 1991 as free software. It allowed anyone to encrypt their emails and files with military-grade cryptography. The government was furious. Zimmermann became the subject of a criminal investigation for allegedly violating export restrictions. The case dragged on for years before being dropped in 1996. But Zimmermann had made his point. Cryptography was no longer the exclusive domain of governments. The genie was out of the bottle, and the cypherpunks continued to push the boundaries, exploring how cryptography could be used not just to protect communication, but to enable new forms of interaction, new kinds of trust, in a digital world where trust was scarce. Among the ideas that emerged from the cypherpunk mailing list, a freewheeling online forum where these thinkers exchanged ideas, was the concept of digital money. If cryptography could protect privacy, could it also create a form of currency that did not depend on banks or governments? The idea was tantalizing. Throughout the 1990s, several attempts were made to create digital currencies. In 1989, David Chaum, a cryptographer and computer scientist, founded DigiCash. Chaum had invented a system called eCash, which used cryptographic techniques to create anonymous digital money. The idea was brilliant. Users could withdraw digital tokens from a bank, and those tokens could be spent without revealing the identity of the spender. The bank could verify that the tokens were legitimate without knowing who was using them. It was a form of digital cash that preserved privacy. But DigiCash had a fatal flaw. It still depended on banks. Users had to trust the bank to issue the tokens and to honor them, and in the end, DigiCash failed. The company went bankrupt in 1998, a victim of poor business, decisions and the reluctance of banks to adopt a system that threatened their control over money. Other attempts followed. In 1996, a company called eGold launched a digital currency backed by physical gold stored in vaults. Users could open accounts and transfer eGold to each other. At its peak, eGold had millions of users and processed billions of dollars in transactions. But it too faced problems. Because it operated outside the traditional banking system, it became a magnet for money laundering and fraud. In 2007, the US government shut down eGold, charging its operators with running an unlicensed money-transmitting business. The pattern was clear. Centralized digital currencies, no matter how innovative, were vulnerable. They could be shut down, regulated, co-opted. If digital money was going to work, it had to be decentralized. It had to exist without a single point of failure, without a company or a government that could pull the plug. In 1998, a computer scientist named Wei Dai proposed a concept called B-money. It was never implemented, but the ideas were groundbreaking. Dai envisioned a system where digital currency would be created through a proof-of-work mechanism, where participants would solve computational puzzles to generate new money. Transactions would be recorded on a collective ledger maintained by the entire network, not by a central authority. And users would remain anonymous, identified only by their cryptographic keys. Dai's B-money proposal contained many of the core ideas that would later appear in Bitcoin. In fact, Satoshi Nakamoto, the creator of Bitcoin, would cite B-money in the Bitcoin white paper. But B-money remained theoretical. Dai did not have a clear solution for how to prevent double spending, the problem of someone using the same digital token twice, or how to achieve consensus among a distributed network of participants who might not trust each other. Around the same time, another computer scientist, Nick Szabo, was working on a similar idea. He called it BitGold. Szabo proposed a system where users would solve cryptographic puzzles, and the solutions would be time-stamped and chained together to create a secure, decentralized ledger. Each puzzle solution would represent a unit of bit gold, and the difficulty of the puzzles would adjust over time to control the rate at which new bit gold was created. It was, in many ways, a blueprint for Bitcoin. Szabo even anticipated the need for a system to prevent double spending and to achieve consensus in a decentralized network. But like B-money, BitGold was never implemented. Szabo could not solve the problem of how to make the system truly secure and scalable. And so BitGold remained an idea, a sketch, a signpost pointing towards something that did not yet exist. There was one more piece of the puzzle that needed to be in place. In 1997, a British cryptographer named Adam Back invented something called Hashcash. Hashcash was not a currency. It was a proof-of-work system designed to combat email spam. The idea was simple but clever. To send an email, a user would have to perform a small amount of computational work, solving a cryptographic puzzle that would take a few seconds. For a normal user sending a handful of emails, this was no big deal. But for a spammer trying to send millions of emails, the computational cost would be prohibitive. Hashcash used a cryptographic function called a hash, which takes an input and produces a fixed-length output. The output looks random, and there is no way to predict it without actually computing the hash. To solve a hashcash puzzle, a user had to find an input that, when hashed, produced an output with a certain number of leading zeros. The more zeros required, the harder the puzzle. This was proof of work. It proved that the user had expended computational resources, and it could not be faked or cheated. Hashcash itself was not widely adopted for its original purpose, stopping spam. But the concept of proof of work would become central to Bitcoin. It was the mechanism by which new Bitcoins would be created and by which the network would agree on which transactions were valid. Proof of work was the key to solving the problem that had stumped earlier attempts at digital currency. It provided a way to achieve consensus in a decentralized network without relying on trust. Instead of trusting a bank or a company, users would trust mathematics. They would trust the fact that solving a cryptographic puzzle required real work, real energy, and that this work could not be faked. It was a profound insight, and it was waiting for someone to put all the pieces together. That someone, or that group of someones, appeared in the fall of 2008. As the financial world was collapsing, as Lehman Brothers was filing for bankruptcy, and the government was scrambling to prevent a complete meltdown, an email appeared on a cryptography mailing list. The sender used the name Satoshi Nakamoto. The email announced a new electronic cash system called Bitcoin. It was, the email said, a purely peer-to-peer version of electronic cash that would allow online payments to be sent directly from one party to another without going through a financial institution. The email included a link to a 9-page white paper titled Bitcoin, a peer-to-peer electronic cash system. The white paper was elegant, concise, and revolutionary. It described a system that combined all the ideas that had been floating around the Cypherpunk community for years: public key cryptography, proof of work, a decentralized ledger. And it solved the problems that had defeated earlier attempts. The timing was not a coincidence. The domain bitcoin.org had been registered on August 18th, 2008, a month before Lehman Brothers collapsed, but the white paper was released on October 31st, 2008, 6 weeks after the bankruptcy, as the full scale of the financial crisis was becoming clear. And then, on January 3rd, 2009, Satoshi Nakamoto mined the first block of the Bitcoin blockchain, the Genesis block. Embedded in that block, in the code itself, was the message that we began with. The Times 03, Jan 2009, Chancellor on brink of second bailout for banks. It was a reference to a headline in the London Times that day. The British government was preparing to inject more money into the banking system to prevent further failures. Satoshi had encoded this headline into the very DNA of Bitcoin, a timestamp, yes, but also a statement of purpose. Bitcoin was born as a response to the failure of the traditional financial system. It was a rejection of bailouts, of too big to fail, of the idea that ordinary people should bear the cost of bankers' mistakes. But who was Satoshi Nakamoto? To this day, no one knows. The name is almost certainly a pseudonym. Satoshi communicated only through emails and forum posts, and was careful never to reveal any personal information. He, or she, or they claimed to be a man living in Japan, but the emails were written in fluent idiomatic English and were often sent during hours that suggested someone living in North America or Europe. Over the years, many people have been suspected of being Satoshi. Nick Szabo, the creator of BitGold, because of the similarities between BitGold and Bitcoin. Hal Finney, the cryptographer who received the first Bitcoin transaction, because he lived near a man named Dorian Satoshi Nakamoto, which some thought was too much of a coincidence. Wei Dai, the creator of B-Money, even groups of people, the idea that Satoshi was not one person but a collective. But none of these theories have been proven. Satoshi disappeared in 2010, handing over the Bitcoin source code to other developers and ceasing all communication. The Bitcoins in the Genesis block, worth hundreds of millions of dollars today, have never been moved. Satoshi is a ghost, a cipher, a legend. And perhaps that is fitting. Bitcoin was designed to work without trust in any individual or institution. It was designed to be decentralized, leaderless, uncensorable. If Satoshi had remained, if he had become the public face of Bitcoin, it would have undermined the very purpose of the project. Bitcoin would have had a leader, a single point of failure. By disappearing, Satoshi ensured that Bitcoin belonged to no one and to everyone. It was a kind of gift, left on the doorstep of the internet with no return address. But before we explore what Bitcoin is and how it works, let us linger a moment longer on the world that created it. Let us understand the depth of the crisis, the scale of the betrayal, that made people willing to trust an anonymous stranger's code more than they trusted the banks. The 2008 financial crisis was not just an economic event. It was a crisis of legitimacy. For decades, the public had been told that the financial system was stable, that it was regulated, that the adults were in charge. Banks and investment firms presented themselves as prudent stewards of capital. They spoke in the language of risk management and due diligence. They hired the best minds from the best universities. They employed sophisticated mathematical models to measure and hedge risk. And all of it, it turned out, was a lie. Or if not a lie, then a delusion so profound that it might as well have been. The banks had not managed risk. They had amplified it. They had created a vast interconnected web of debt and speculation that no one fully understood. And when it collapsed, they came to the government, hat in hand, and demanded to be saved. Not because they deserved to be saved, but because the alternative, they said, was too terrible to contemplate. The entire economy would collapse. Millions more would lose their jobs. It was a kind of extortion. Save us, or everyone suffers, and the government did save them, but at what cost? The bailouts were deeply unpopular. Polls showed that a majority of Americans opposed TARP. There were protests in the streets. The Tea Party movement, which would reshape American politics, was born in part out of anger over the bailouts. On the left, the Occupy Wall Street movement emerged, decrying income inequality and the power of the financial elite. The phrase, "we are the 99%, became a rallying cry. People felt powerless. They felt that the system was rigged against them, and they are not wrong. A study by the Federal Reserve found that the median American household lost nearly 40% of its wealth between 2007 and 2010. Meanwhile, the bankers who had caused the crisis largely escaped accountability. Some lost their jobs, but few faced criminal charges. The largest banks became even larger, absorbing their failed competitors. And within a few years, Wall Street was profitable again, paying out record bonuses. It was as if the crisis had never happened, except, of course, it had, and millions of people would never forget. This was the soil in which Bitcoin took root, a soil of anger, of distrust, of a deep hunger for an alternative. People were looking for a way to opt out of a system that had betrayed them, and Bitcoin offered that possibility. It was money that did not depend on banks. It was money that could not be debased by central banks printing more of it. It was money that was, in theory, beyond the reach of governments. Of course, in 2009, almost no one understood what Bitcoin was. When Satoshi released the software, only a handful of cryptographers and computer enthusiasts paid attention. In the early days, you could mine Bitcoins on a regular laptop. The network consisted of a few dozen nodes. A Bitcoin was worthless in terms of dollars because there was no market for it. The first recorded transaction where Bitcoin was used to buy something in the real world did not happen until May 2010, when a programmer named Laszlo Haniec paid 10,000 Bitcoins for 2 pizzas. At the time, it seemed like a novelty. Today, those Bitcoins would be worth hundreds of millions of dollars. But Haniec does not regret it. Someone had to be the first, he said. Someone had to show that Bitcoin could be used as money. Slowly, very slowly, Bitcoin began to grow. Early adopters were drawn by the technology, by the elegance of Satoshi's solution to the double spending problem, by the libertarian ideals embedded in the project. They believed that money should be separated from the state, just as, centuries earlier, religion had been separated from the state. They believed that individuals should have the freedom to transact with each other without asking permission from a bank or a government. These were not mainstream ideas. In the early years, Bitcoin was associated with the fringes of the internet, with online black markets and with people who distrusted authority. But gradually, others began to take notice. Computer scientists admired the technical innovation. Economists debated whether Bitcoin could function as a currency. Investors, always on the lookout for the next big thing, began to speculate. And people in countries with unstable currencies, with hyperinflation or capital controls, began to see Bitcoin as a lifeline. By 2011, Bitcoin had reached parity with the US dollar. 1 Bitcoin was worth $1. By June of that year, it briefly touched $30 before crashing back down. The volatility was extreme. Critics said it proved that Bitcoin was a bubble, a speculative mania with no intrinsic value. Supporters said that volatility was natural for a new asset, and that over time, as the market matured, the price would stabilize. Both were partly right. Bitcoin's price would continue to swing wildly, rising to over $1,000 in late 2013, then collapsing again, then rising even higher in subsequent years. It was a roller coaster. But through it all, the network kept running. The blockchain kept growing. Transactions kept being processed, and with each passing year, Bitcoin became a little more real, a little more difficult to dismiss. But we're getting ahead of ourselves. Before we follow Bitcoin's journey into the present, we need to understand how it works. We need to peer inside the machinery, the cryptographic gears and economic incentives that make Bitcoin possible. We need to understand what Satoshi Nakamoto actually invented. Because Bitcoin is not just a currency. It is a new kind of consensus mechanism, a way for strangers to agree on the truth without needing to trust each other or any central authority. It is, in a sense, a social technology as much as it is a computer technology. And to grasp its significance, we must start with the most fundamental question. What is money, and why do we need it? Money is one of humanity's oldest inventions. Before money there was barter. If you had grain and I had wool, we could trade. But barter is inefficient. It requires a double coincidence of wants. I have to have what you want, and you have to have what I want at the same time. Money solves this problem by acting as a medium of exchange. Instead of trading grain for wool, I can sell my grain for money and then use that money to buy wool or anything else whenever I want. Money also serves as a unit of account, a way to measure value, and it serves as a store of value, a way to save wealth for the future. These are the three functions of money taught in every economics textbook: medium of exchange, unit of account, store of value. But for money to work, people have to believe in it. They have to trust that the money they accept today will still be valuable tomorrow. Throughout history, different things have been used as money: shells, beads, salt, precious metals like gold and silver. These were chosen because they were scarce, durable, divisible, and portable. Gold, in particular, became the dominant form of money for thousands of years. It is beautiful, it does not tarnish, it is rare enough to be valuable but common enough to be practical. But gold has a problem. It is heavy and difficult to transport. If you wanted to buy something expensive, you would have to carry a lot of gold, and gold could be stolen. So people began to deposit their gold with goldsmiths, who would store it in vaults and give the depositor a receipt. These receipts could be traded as if they were gold itself. If you wanted to buy something, you could hand over the receipt, and the recipient could redeem it for gold from the goldsmith. This was the birth of paper money. The paper itself was worthless, but it represented a claim on real gold. Over time, goldsmiths realized that not everyone would redeem their receipts at the same time. They could issue more receipts than they had gold in the vault, lending out the extra receipts and charging interest. As long as people trusted that they could get their gold back if they wanted it, the system worked. This was the birth of fractional reserve banking. Banks held only a fraction of the deposits in reserve and lent out the rest. It was a powerful system because it allowed money to be created through lending, which fueled economic growth. But it was also fragile. If too many people tried to withdraw their gold at once, a bank run, the bank would collapse. And if one bank collapsed, panic could spread, causing runs on other banks. This is why governments eventually stepped in, creating central banks to act as lenders of last resort, to provide liquidity to banks in times of crisis, and to regulate the system. In the United States, the Federal Reserve was created in 1913, after a series of devastating banking panics. But the link between paper money and gold did not last forever. In the 20th century, especially after World War II, most countries adopted the Bretton Woods system, where currencies were pegged to the US dollar, and the dollar was convertible to gold at a fixed rate, $35 per ounce. But by the 1960s, the United States was printing more dollars than it had gold to back them. Other countries began to lose confidence and demanded gold for their dollars. In 1971, President Richard Nixon ended the dollar's convertibility to gold. The Bretton Woods system collapsed. From that point on, the dollar and every other major currency was what is called fiat money. Fiat from the Latin for let it be done. Fiat money has value because the government says it does, and because people accept it. It is not backed by gold or any physical commodity. It is backed by trust in the government and the economy. This system has worked, more or less, for the past 50 years. But it has a fundamental weakness. Governments can print as much money as they want, and when they do, the value of each unit of money goes down. This is inflation. A little inflation is normal and even healthy for an economy. It encourages people to spend and invest rather than hoard money. But too much inflation, or worse, hyperinflation, can destroy an economy. People lose faith in the currency. Prices spiral out of control. Savings become worthless. This has happened many times throughout history. In Germany in the 1920s, in Zimbabwe in the 2000s, in Venezuela more recently. And even in stable countries, The slow erosion of purchasing power over time is a hidden tax on savers. $1 today does not buy what $1 bought 20 years ago. The government, through the central bank, has the power to create money and to control its supply. And this power, critics say, is too easily abused. This is where Bitcoin enters the picture. Bitcoin is designed to be the opposite of fiat money. It is not controlled by any government or central bank. Its supply is fixed and transparent. There will only ever be 21 million Bitcoins. This limit is written into the code and cannot be changed without the agreement of the entire network. New Bitcoins are created through a process called mining, which we'll explain shortly, and the rate at which they are created is also fixed, decreasing over time in a predictable way. Every 4 years, the reward for mining a block is cut in half, an event known as the halving. This means that the supply of new Bitcoins slows over time, approaching but never quite reaching the 21 million limit. It is a form of digital scarcity, designed to mimic the scarcity of gold. In fact, Bitcoin is often called digital gold. But how does Bitcoin actually work? How can a digital file, which can be copied infinitely, have scarcity? This was the central problem that earlier digital currencies could not solve. If I send you a digital file, I still have a copy of it. I can send the same file to someone else. This is called the double spending problem. With physical money, if I give you a dollar bill, I no longer have it. But with digital money, what prevents me from spending the same dollar twice? The traditional solution is to have a trusted third party, a bank, keep track of who owns what. When I want to send you money, I tell the bank, and the bank updates its ledger, subtracting from my account and adding to yours. The bank ensures that I cannot spend the same dollar twice. But this solution requires trust. We have to trust the bank to keep accurate records, to not lose our money, to not freeze our accounts. And as the 2008 crisis showed, that trust can be misplaced. Satoshi's genius was to create a system where the ledger, the record of who owns what, is not kept by a single trusted party, but by the entire network. Every participant has a copy of the ledger, and they all agree on what it says. This ledger is the blockchain. It is called a blockchain because it is made up of blocks of transactions, each block linked to the previous one, forming a chain. When someone wants to make a transaction, to send bitcoins to someone else, they broadcast that transaction to the network. Nodes on the network, computers running the Bitcoin software, collect these transactions into a pool. Then, special nodes called miners compete to add the next block of transactions to the blockchain. Here is where proof of work comes in. To add a block, a miner must solve a cryptographic puzzle. The puzzle involves finding a number, called a nonce, such that when the block's data is hashed along with the nonce, the resulting hash has a certain number of leading zeros. This is difficult. It requires trying billions of different nonces until one works. The first miner to find a valid nonce broadcasts the new block to the network. Other nodes verify that the block is valid, that the transactions in it are legitimate, that the nonce is correct. If everything checks out, they add the block to their copy of the blockchain. And the miner who found the block is rewarded with newly created bitcoins. This is how new bitcoins enter circulation. It is also how the network agrees on which transactions are valid. Why does this system work? Why can we trust that the ledger is accurate, even though there is no central authority? The answer lies in the incentives. Miners are rewarded for adding valid blocks. If they try to cheat, to add a block with invalid transactions, or to spend the same bitcoins twice, other nodes will reject the block, and the miner will get no reward. In fact, they will have wasted all the computational power they used to solve the puzzle. so it is in every miner's interest to play by the rules. And because the blockchain is public, anyone can verify that the rules are being followed. If you want to check whether a transaction is valid, you can download the entire blockchain and trace every Bitcoin back to its origin. The system is transparent in a way that traditional banking never could be. You cannot see the transactions in your neighbor's bank account, but you can see every Bitcoin transaction ever made, though you cannot necessarily tell who made them, because users are identified by cryptographic addresses, not by names. There is another layer of security built into the blockchain. Each block contains a hash of the previous block. This creates a chain. If someone tries to alter a past transaction, they would have to change the block containing that transaction. But changing the block would change its hash, and that would break the chain, because the next block contains the old hash, so the attacker would have to recalculate the hash for every subsequent block, all the way to the present. And because each block requires solving a computationally difficult puzzle, this would take an enormous amount of computing power. The further back in the blockchain a transaction is, the more difficult it is to alter. After a transaction has been confirmed by several blocks, it is effectively irreversible. This is why people often wait for multiple confirmations before considering a transaction final. The blockchain is not just a ledger, it is a ledger secured by proof of work, a ledger that becomes more secure with every block that is added. Critics of Bitcoin often point to the energy consumption of mining. They are not wrong to raise the issue. Mining requires vast amounts of electricity. Miners are running powerful computers, trying trillions of hashes per second, all competing to find the next block. Estimates vary, but Bitcoin mining consumes as much energy as a medium-sized country. Proponents argue that this energy is not wasted, that it is the cost of securing the network, of creating a form of money that is uncensorable and decentralized. They point out that much of the energy used in mining comes from renewable sources, especially hydroelectric power, because miners seek out the cheapest electricity, and renewables are often the cheapest. They also argue that traditional banking and gold mining consume far more energy when you account for all the buildings, armored cars, security systems, and infrastructure involved. But the debate continues. It is a trade-off. Decentralization and security come at a cost, and that cost, in Bitcoin's case, is energy. There is also the question of scalability. Bitcoin can process only a limited number of transactions per second, around 7, compared to thousands for systems like Visa. This has led to high transaction fees during times of heavy use, and to debates within the Bitcoin community about how to scale the network. Some proposed increasing the block size to allow more transactions per block. Others argued that this would make it harder for individuals to run nodes, leading to centralization. In the end, the community split, and a new cryptocurrency, Bitcoin Cash, was created by those who wanted larger blocks. Bitcoin itself has remained relatively unchanged, focusing on being a store of value rather than a medium for everyday transactions. Other solutions, like the Lightning Network, have been developed to enable faster, cheaper transactions by moving them off the main blockchain and settling them later. These are technical debates, and they reveal something important. Bitcoin is not a finished product. It is an experiment, constantly evolving, shaped by the people who use it and the developers who maintain it. But let us return to our central question. Why did Bitcoin start during a financial crisis? We have explored the technical foundations, the cypherpunk ideals, the failures of earlier digital currencies. We have seen how the 2008 crisis exposed the fragility and corruption of the traditional financial system. But there is a deeper connection. Bitcoin is not just a reaction to the crisis, It is an embodiment of the lessons learned from it. It is a system designed to prevent the kinds of abuses that led to the crisis. Let us consider those abuses one by one and see how Bitcoin addresses them. First, there is the problem of centralized control. In the traditional system, a small number of institutions, banks and central banks, control the money supply. They decide how much money to create, who gets access to credit, what the interest rates are. This concentration of power leads to moral hazard. If a bank knows it will be bailed out if it fails, it has less incentive to be prudent. It can take bigger risks because the profits are privatized, but the losses are socialized. The taxpayers bear the cost. Bitcoin eliminates centralized control. There is no central bank. No one can print more Bitcoins. No one can decide who gets to use Bitcoin and who does not. The rules are set by the code, and they apply to everyone equally. This is what people mean when they say Bitcoin is trustless. You do not have to trust a bank or a government. You trust the math. Second, there is the problem of opacity. The financial products that caused the 2008 crisis, the mortgage-backed securities, the collateralized debt obligations, were so complex that even the people who created them did not fully understand them. They were black boxes, and this opacity allowed risk to be hidden and misrepresented. Investors bought securities they thought were safe, only to discover they were toxic. Bitcoin is the opposite. It is radically transparent. Every transaction is recorded on the blockchain, visible to anyone. The code is open source, meaning anyone can examine it, audit it, verify that it does what it claims to do. There are no hidden fees, no fine print. Of course, this transparency has limits. Users are pseudonymous, identified by addresses rather than names. But the transactions themselves are public. If you know someone's address, you can see their entire transaction history. This level of transparency is unprecedented in the history of money. Third, there is the problem of inflation. When governments face a crisis, they often respond by printing money. This can provide short-term relief, but it dilutes the value of the currency. Savers are punished. Those who hold cash see their purchasing power erode. In the wake of the 2008 crisis, central banks around the world engaged in unprecedented monetary expansion, a policy known as quantitative easing. They created trillions of dollars, euros, yen out of thin air and used that money to buy bonds and other assets. The stated goal was to stimulate the economy, to prevent deflation, to keep credit flowing. But the side effect was to inflate asset prices. Stocks, real estate, anything that could be bought with borrowed money became more expensive. This benefited those who already owned assets, the wealthy. But it hurt those who did not, the young, the poor, the middle class. Inequality widened. Bitcoin offers an alternative. Its supply is fixed. No one can inflate it away. If you own 1 Bitcoin today, you will always own a fixed fraction of the total supply. In a world where the money supply is 21 million, owning 1 Bitcoin means you own 1/21 millionth of all Bitcoins. That fraction cannot change no matter what governments or central banks do. But Bitcoin is not without its critics, and their concerns are worth considering. Some say that Bitcoin is too volatile to be a currency. Its price swings are dramatic. A merchant who accepts Bitcoin might find that by the time they convert it to dollars, it has lost half its value, or gained double. This makes it difficult to use for everyday transactions. Proponents respond that volatility will decrease as the market matures, as Bitcoin becomes more widely adopted and the price stabilizes. But until then, Bitcoin functions more as a speculative asset, as digital gold than as a medium of exchange. Others say that Bitcoin is used for illegal activities, for buying drugs on the dark web, for money laundering, for ransomware payments. This is true to some extent. Bitcoin's pseudonymity makes it attractive to criminals, but it is also true that the vast majority of illegal transactions still happen in cash, in dollars and euros. And Bitcoin's transparency, the fact that every transaction is recorded on the blockchain, actually makes it easier for law enforcement to trace illicit activity once they identify the addresses involved. Several high-profile cases have resulted in arrests precisely because investigators were able to follow the trail on the blockchain. Then there is the argument that Bitcoin has no intrinsic value. A share of stock represents ownership in a company. A bond is a loan that pays interest. Gold has industrial uses and aesthetic value. But a Bitcoin is just a string of numbers. It does not produce anything. It does not pay dividends. What gives it value? The answer, Bitcoin supporters say, is the same thing that gives any money value: belief. People value Bitcoin because they believe others will value it in the future, because it has properties that make it useful as money: scarcity, divisibility, portability, durability, and most importantly, because it cannot be controlled by any government or institution. This last property, censorship resistance, is what sets Bitcoin apart. In countries with authoritarian regimes, with capital controls, with hyperinflation, Bitcoin offers a way to preserve wealth, to transact freely, to escape the control of the state. This is not a theoretical benefit, it is real. People in Venezuela, in Argentina, in Zimbabwe, in countries where the local currency is collapsing, have turned to Bitcoin. Not because they are libertarian ideologues, but because it is the best option available to them. And so Bitcoin entered the world quietly, almost invisibly, in the first days of January 2009. While the headlines screamed about bank failures and government bailouts, while millions of people struggled to understand how their savings had vanished, a small group of cryptographers and programmers began downloading software from a stranger on the internet. They compiled the code, ran it on their computers, and began to mine. In those early days, mining was simple. You did not need specialized equipment. A laptop was enough. The difficulty was low, the network was small, and bitcoins were being created at a steady pace, 50 bitcoins per block, every 10 minutes or so. But those bitcoins had no value. They were numbers on a screen, entries in a database that no one cared about except for a handful of enthusiasts who believed, or hoped, that they were participating in something important. On January 9th, 2009, Satoshi released version 0.1 of the Bitcoin software. He announced it on a cryptography mailing list with a message that was characteristically understated, announcing the first release of Bitcoin, a new electronic cash system that uses a peer-to-peer network to prevent double spending. It is completely decentralized with no server or central authority. The message explained the basic features. Users hold the crypto keys to their own money and transact directly with each other, with the help of the network to check for double spending. There were a few responses, some curious, some skeptical. The idea seemed interesting, but also impractical. How could it scale? How would people trust it? What would prevent it from being shut down? Satoshi patiently responded to questions, explained the mechanisms, defended his design choices. But most people on the mailing list moved on. They had seen digital currency ideas before. Most had failed. 3 days later, on January 12th, 2009, the first Bitcoin transaction between two people took place. Satoshi sent 10 Bitcoins to Hal Finney, a respected cryptographer and early member of the Cypherpunk movement. Finney had downloaded the software and was running a node. He was one of the first, perhaps the very first besides Satoshi, to believe that Bitcoin might actually work. Finney would later write about his excitement that day. When Satoshi announced Bitcoin on the cryptography mailing list, he got a skeptical reception at best. Cryptographers have seen too many grand schemes by clueless noobs. I was more positive. I had long been interested in cryptographic payment schemes. I was lucky enough to meet and extensively correspond with both Wei Dai and Nick Szabo, generally acknowledged to have created ideas that would be realized with Bitcoin. I had made an attempt to create my own proof-of-work-based currency, so I found Bitcoin fascinating. Finney mined block 70, one of the earliest blocks after the Genesis block, and for a brief, thrilling moment, he allowed himself to imagine a future where Bitcoin succeeded beyond anyone's wildest dreams. He did a back-of-the-envelope calculation. If Bitcoin became the dominant payment system in the world, if it replaced all the money in circulation, then each Bitcoin would be worth millions of dollars. It was a fantasy, of course. The odds were astronomically against it, but it was a beautiful fantasy, and so Finney kept mining, kept running his node, kept believing. Tragically, Finney would later be diagnosed with ALS, a degenerative disease that gradually paralyzed his body. He continued to work on Bitcoin as long as he could, typing with his eyes when his hands no longer worked. He passed away in 2014 at the age of 58. His body was cryogenically preserved, a final act of optimism, a bet that future technology might one day restore him. Finney was a dreamer, a builder, a believer in the power of cryptography to change the world, and his early support gave Bitcoin credibility, showed that serious people were taking it seriously. Throughout 2009, Bitcoin remained a niche project. A few dozen people were mining, a few dozen more were watching with interest. The network was fragile. If Satoshi and a handful of others had stopped running their nodes, Bitcoin might have died. But they kept going. Satoshi continued to refine the software, releasing updates, fixing bugs, responding to questions. In October of 2009, the first Bitcoin exchange rate was published. An organization called New Liberty Standard calculated that one Bitcoin was worth approximately 0.08 of a cent, based on the cost of electricity required to mine it. By this measure, $1 could buy more than 1,000 Bitcoins. It was a start. It was a way to assign value, however arbitrary, to these digital tokens. And once value could be assigned, trade became possible. In 2010, things began to change. Bitcoin started to attract more attention. In May of that year, Laszlo Hanyecz, a programmer and early Bitcoin enthusiast, made history. He wanted to demonstrate that Bitcoin could be used to buy real goods. He posted on a Bitcoin forum offering 10,000 Bitcoins to anyone who would order him 2 pizzas. Someone took him up on the offer, ordering the pizzas from Papa John's and having them delivered to Hanyecz's house. The transaction was completed. 10,000 Bitcoins for 2 pizzas. At the time, those Bitcoins were worth about $40. Today, they would be worth hundreds of millions. May 22nd is now celebrated in the Bitcoin community as Bitcoin Pizza Day, a reminder of how far the currency has come and of the importance of those early adopters who were willing to use Bitcoin, to spend it, to treat it like real money. Hanyecz does not regret the transaction. He has said many times that someone had to be first. Someone had to prove that Bitcoin was not just a theoretical exercise, but a medium of exchange. Later that year, in July 2010, Bitcoin was mentioned on the technology news site Slashdot. The post described Bitcoin as a new cryptocurrency that claimed to be both anonymous and secure. The attention brought a flood of new users. The Bitcoin network, which had been processing a handful of transactions per day, suddenly faced a surge in activity. The price began to rise. By the end of 2010, one Bitcoin was worth approximately 30 cents, a nearly 400-fold increase from the previous year's estimate. More exchanges appeared, making it easier to buy and sell Bitcoin. More developers joined the project, contributing code, proposing improvements. Bitcoin was still tiny compared to the global financial system, but it was growing. And with each new user, each new transaction, the network became a little more robust, a little more real. But growth brought challenges. The more visible Bitcoin became, the more it attracted scrutiny. Law enforcement agencies began to worry that Bitcoin could be used for money laundering, for buying illegal goods, for evading taxes. In February 2011, the online black market Silk Road was launched. It operated on the Tor network, the dark web, and it accepted only Bitcoin as payment. Users could buy drugs, forged documents, hacking services, all anonymously, or so they believed. Silk Road was a boon for Bitcoin's adoption in a perverse way. It demonstrated that Bitcoin worked, that it could facilitate real transactions at scale. But it also tainted Bitcoin's reputation. To many people, Bitcoin became synonymous with crime. This association would haunt Bitcoin for years, overshadowing its legitimate uses and its philosophical foundations. In April 2011, Time magazine published an article about Bitcoin, bringing it to an even wider audience. The price spiked. By June, one Bitcoin was worth more than $30. But the rally was short-lived. Mt. Gox, which had become the largest Bitcoin exchange, suffered a security breach. Hackers exploited vulnerabilities in the exchange's system, manipulated prices, and stole Bitcoins. Confidence plummeted. The price crashed to around $2 by the end of 2011. It was Bitcoin's first major boom and bust cycle, a pattern that would repeat many times. Critics said the crash proved that Bitcoin was a bubble, that it had no real value, that it would fade into obscurity. But Bitcoin did not die. The network kept running, miners kept mining, developers kept developing. And gradually the price began to recover. By 2012, Bitcoin was entering a new phase. It was no longer just an experiment, it was becoming an ecosystem. Businesses began to accept Bitcoin as payment. The WordPress blogging platform announced it would accept Bitcoin, a significant endorsement. The Bitcoin Foundation was established to promote Bitcoin and support its development. And the first Bitcoin ATM was being planned, a machine that would allow people to exchange cash for Bitcoin and vice versa. The technology itself was also evolving. Developers proposed improvements to the protocol, ways to make Bitcoin more scalable, more private, more user-friendly. Some of these proposals were implemented, others sparked fierce debates that would divide the community. One of the most important events in Bitcoin's life cycle, built into its very code, is the halving. Every 210,000 blocks, approximately every 4 years, the reward for mining a block is cut in half. When Bitcoin launched, miners received 50 Bitcoins per block. In November 2012, the first halving occurred. The reward dropped to 25 Bitcoins per block. This halving was designed to control the supply of Bitcoin, to ensure that new Bitcoins are created at a predictable, decreasing rate. It mimics the scarcity of precious metals like gold, where the easy-to-mine deposits are extracted first, and over time, it becomes harder and more expensive to find more. The halving also has psychological and economic effects. In the months leading up to a halving, anticipation builds. Traders speculate on how the reduced supply will affect the price. Historically, each halving has been followed by a significant price increase, though the pattern is not guaranteed to continue. In 2013, Bitcoin captured mainstream attention in a way it never had before. The price began the year around $13. By April, it had reached $260. The rally was driven by a combination of factors. The financial crisis in Cyprus, where the government imposed a tax on bank deposits to fund a bailout, reminded people of the risks of trusting traditional banks. Bitcoin, by contrast, could not be seized or taxed without the owner's private key. Then there was the growing media coverage, the sense that Bitcoin was the next big thing, a chance to get in on the ground floor of a revolutionary technology. By November 2013, the price had reached over $1,100, but once again, the rally could not be sustained. Concerns about regulation, about security, about whether Bitcoin was a bubble, led to a sell-off. The price fell back below $500 by the end of the year. The following year, 2014, brought one of Bitcoin's darkest chapters. Mt. Gox, which at its peak had handled 70% of all Bitcoin transactions, collapsed. The exchange had been hacked, and over 850,000 Bitcoins, worth nearly $500 million at the time, were missing. The CEO, Mark Karpeles, a French programmer living in Japan, was arrested and charged with embezzlement and fraud, though he maintained that the Bitcoins had been stolen by hackers. The Mt. Gox collapse was a disaster for Bitcoin. It wiped out the savings of thousands of people. It reinforced the narrative that Bitcoin was risky, unregulated, a playground for hackers and scammers. The price fell to around $200 and stayed there for more than a year. It seemed to many observers that Bitcoin might never recover, that it had been a fad, a bubble, and now it was over. But again, Bitcoin survived. The network did not stop. The blockchain kept growing, and the community, battered and bruised, began to rebuild. New exchanges emerged with better security practices. Regulators began to develop frameworks for overseeing cryptocurrency businesses, providing some legal clarity and consumer protection. And a new generation of users and investors, drawn by the promise of decentralization and the potential for profit, began to discover Bitcoin. By 2016, the price was rising again. The narrative was shifting. Bitcoin was no longer just a curiosity or a tool for criminals. It was being discussed as a legitimate asset class, as digital gold, as a hedge against inflation and financial instability. In 2017, Bitcoin experienced its most dramatic bull run yet. The price started the year at under $1,000. By December, it had reached nearly $20,000. The rally was fueled by a frenzy of speculation, by fear of missing out, by the proliferation of initial coin offerings, ICOs, where new cryptocurrencies were launched and sold to investors. Blockchain became a buzzword. Companies added blockchain to their names and saw their stock prices soar, even if they had no real involvement in the technology. It was a mania, reminiscent of the dot-com bubble of the late 1990s, and like that bubble, it burst. By the end of 2018, Bitcoin's price had fallen to around $3,000, an 80% decline from its peak. Yet once more, Bitcoin endured. The crashes, the scandals, the skepticism, none of it killed Bitcoin. And perhaps that is the most remarkable thing about it. Bitcoin has no CEO to fire, no board of directors to replace, no headquarters to shut down. It exists as a distributed network, maintained by thousands of participants around the world. As long as even a handful of people keep running the software, keep mining blocks, keep validating transactions, Bitcoin will continue to exist. It is resilient in a way that no centralized system could be. And this resilience, this anti-fragility, is part of what makes Bitcoin valuable. It is money that cannot be destroyed by any single actor, any single event. The story of Bitcoin is also the story of a philosophical divide, a fundamental disagreement about what Bitcoin should be. Is it digital cash, meant to be used for everyday transactions to buy coffee and groceries? Or is it digital gold, a store of value, an asset to be held long-term as a hedge against inflation? Satoshi's white paper described Bitcoin as a peer-to-peer electronic cash system, suggesting the former. But as Bitcoin grew, as the network became congested and transaction fees rose, it became impractical to use Bitcoin for small purchases. The community split over how to address this. Some wanted to increase the block size, to allow more transactions per block. Others argued that keeping blocks small was necessary to ensure that anyone could run a node, preserving decentralization. The debate became bitter, personal. In 2017, it led to a fork, a split in the blockchain. Bitcoin Cash was created by those who wanted larger blocks. Bitcoin itself remained largely unchanged, with its supporters focusing on Layer 2 solutions like the Lightning Network, which allows transactions to be processed off-chain and settled on the blockchain later. This debate reveals something important about Bitcoin. It is not controlled by any single person or group. Changes to the protocol require consensus, and achieving consensus is difficult. This is by design. It makes Bitcoin resistant to change, resistant to capture by any faction, but it also makes it slow to adapt, slow to innovate. Whether this is a feature or a bug depends on your perspective. If you believe that the most important characteristic of money is stability, that the rules should be predictable and unchanging, then Bitcoin's resistance to change is a strength. If you believe that money should evolve, that it should become faster, cheaper, more efficient, then Bitcoin's inflexibility is a weakness. There is no right answer. Different people want different things from money. And that is why thousands of alternative cryptocurrencies have been created, each with its own vision, its own trade-offs. But let us return to our central theme, the relationship between Bitcoin and the financial crisis. We have traced the technical and historical development of Bitcoin. Now let us consider its deeper significance. Bitcoin is more than a technology. It is a social movement. It is a statement about trust, about power, about the relationship between individuals and institutions. The 2008 crisis was not just an economic failure, it was a failure of trust. People trusted banks to manage their money prudently. They trusted regulators to enforce the rules. They trusted credit rating agencies to assess risk accurately. They trusted that the system, for all its flaws, was fundamentally sound. And all of that trust was betrayed. When Lehman Brothers fell, when AIG needed to be rescued, when the government wrote checks for $700 billion to save the banks, that trust shattered, and it has never been fully restored. Bitcoin offers a different model. Instead of trust, it offers verification. Instead of relying on institutions, it relies on mathematics. Instead of central control, it offers decentralization. These are not just technical features. They are values, principles, a vision of how society could be organized. And this vision resonates with people who feel powerless, who feel that the system is rigged against them, who want to take back control. This is why Bitcoin appeals to such a diverse group. Libertarians who distrust government, technologists who believe in the power of code, people in developing countries with unstable currencies, activists who want to fund dissent without relying on banks that might freeze their accounts, criminals, yes, but also journalists, whistleblowers, refugees, anyone who needs to transact without asking permission. The crisis also taught a lesson about the fragility of complex systems. The financial system in 2008 was a web of interconnected institutions, each depending on the others, each exposed to the same risks. When one thread broke, the whole web was in danger of collapsing. This is called systemic risk, and it is the price of interconnection. Bitcoin, by contrast, is designed to be resilient. There is no single point of failure. If one node goes offline, the network continues. If one exchange is hacked, the blockchain is unaffected. The distributed nature of Bitcoin makes it robust against attacks, against failures, against censorship. It is a system that can survive even if parts of it are destroyed. And yet Bitcoin is not without its vulnerabilities. It is vulnerable to a 51% attack, where a single entity controls more than half of the network's mining power and could, in theory, rewrite the blockchain. This has never happened with Bitcoin because the cost and coordination required would be enormous, but it remains a theoretical risk. Bitcoin is vulnerable to regulatory crackdowns. If major governments decided to ban Bitcoin to make it illegal to own or trade, it would be difficult to stop them. Bitcoin would continue to exist, but it would be pushed further underground. Its value would likely collapse, and its dream of becoming a global currency would be dead. Bitcoin is vulnerable to technological change. If quantum computing advances to the point where it can break the cryptographic algorithms that secure Bitcoin, the entire system would be at risk. Developers are aware of this and are working on quantum-resistant cryptography, but it is a race against time. Bitcoin is also vulnerable to human nature. Greed, fear, the tendency to follow the crowd, these psychological factors drive the boom and bust cycles that have characterized Bitcoin's history. When prices are rising, people rush in, afraid of missing out. When prices are falling, they panic and sell. This volatility makes Bitcoin difficult to use as a currency. If the value of your money can swing by 10 or 20% in a single day, how can you plan? How can you budget? How can you know what anything is worth? And this volatility is self-perpetuating. Because Bitcoin is volatile, people treat it as a speculative asset rather than as money. They hold it hoping the price will rise rather than spending it. This reduces its utility as a medium of exchange, which in turn makes it more of a speculative asset. It is a feedback loop. Still, over time, as Bitcoin has grown, as the market has matured, the volatility has decreased. The swings are still dramatic by the standards of traditional assets, but they are smaller than they used to be. 1,000% gain or loss in a year is now rare, though not impossible. And as more institutional investors, pension funds, hedge funds, even corporations begin to hold Bitcoin, the market becomes more liquid, more stable. In 2020, the COVID-19 pandemic brought a new wave of interest in Bitcoin. Governments around the world responded to the economic crisis by printing trillions of dollars, euros, yen. Central banks slashed interest rates to zero or even negative. The fear of inflation, of currency debasement, drove people to seek alternative stores of value. Gold rallied, real estate rallied, and Bitcoin rallied. By the end of 2020, the price had reached its previous all-time high of $20,000, and it kept going. In 2021, Bitcoin reached new heights. The price surpassed $60,000 in April, driven by a combination of institutional adoption, celebrity endorsements, and continued concerns about inflation. Companies like Tesla and MicroStrategy bought billions of dollars worth of Bitcoin for their corporate treasuries. El Salvador became the first country to adopt Bitcoin as legal tender, a controversial move that was celebrated by Bitcoin enthusiasts and criticized by economists and international financial institutions. The country's president, Nayib Bukele, argued that Bitcoin would promote financial inclusion, reduce remittance costs, and attract investment. Critics said it would increase volatility, expose the country to risk, and benefit only a small elite. The experiment is still ongoing, and its results remain uncertain. But the 2021 rally, like those before it, could not last forever. By the end of the year, the price had fallen back to around $47,000, and in 2022 it fell further, dropping below $20,000 amid a broader downturn in cryptocurrency markets, scandals involving major exchanges and lending platforms, and rising interest rates that made risky assets less attractive. Yet again, Bitcoin's death was predicted. Yet again, it survived. The cycle continued. And with each cycle, Bitcoin became more entrenched, more accepted, more difficult to ignore. It had gone from a curiosity to a phenomenon to a permanent fixture of the financial landscape. What can we conclude from this history? What does Bitcoin's journey tell us about money, about trust, about the future? One conclusion is that the demand for an alternative to the traditional financial system is real and enduring. People want control over their own money. They want privacy. They want to be able to transact without intermediaries taking a cut or imposing restrictions. Bitcoin may not be perfect. It may not be the final answer. But it has demonstrated that these desires can be met at least partially through technology. It has opened a door that cannot be closed. Even if Bitcoin itself were to fail, the idea of decentralized digital currency would remain. The code is open source. The knowledge is out there. Someone else would pick up the torch. Another conclusion is that technology alone is not enough. Bitcoin's success depends on the community that supports it, the developers who maintain it, the miners who secure it, the users who adopt it. It depends on belief, and belief is fragile. It can be strengthened by positive experiences, by seeing Bitcoin work, by seeing its value increase. But it can also be shattered by scandals, by hacks, by government crackdowns. Bitcoin's future is not predetermined. It will be shaped by the actions of millions of people, by decisions made in boardrooms and legislatures, by technological advances and economic crises. It is a collective experiment, and we are all participants, whether we realize it or not. A third conclusion is that money is not neutral. The choice of what we use as money and who controls it has profound implications for society. Fiat currency gives governments the power to manage the economy, to respond to crises, to fund public services. But it also gives them the power to debase the currency, to inflate away debt, to impose capital controls. Gold and other commodity money limit government power, but they also limit flexibility, making it harder to respond to economic shocks. Bitcoin represents yet another model, one that prioritizes individual sovereignty and predictability over central management. It is a vision that appeals to some and horrifies others, and the debate over which system is better or whether they can coexist will continue for years to come. The story of Bitcoin's origin during the financial crisis is also a story about timing. Ideas often appear before their time. The cypherpunks had been dreaming of digital money for decades. But it was only when the financial system collapsed, Only when millions of people saw the consequences of unchecked power and broken trust that the idea found a receptive audience. Bitcoin could have been invented in the 1990s. The technical pieces were in place, but it might not have gained traction. The crisis created the conditions for Bitcoin's birth, not just technically, but psychologically, culturally, politically. People were ready to hear the message that Satoshi embedded in the Genesis block, Chancellor on brink of second bailout for banks. They were ready to believe that there had to be a better way. And so we return to the question we began with. Why did Bitcoin start during a financial crisis? The answer, we now see, is multi-layered. It started during the crisis because the crisis revealed the flaws of the existing system, flaws that Bitcoin was designed to address. It started during the crisis because the crisis created a moment of possibility, a willingness to consider alternatives that would have seemed radical or absurd in normal times. It started during the crisis because someone or some group saw the chaos and thought, there must be a way to build something better, something that cannot be manipulated or controlled or shut down, and they did. They built Bitcoin, and in doing so, they started a revolution. Not a violent revolution, not a political revolution in the traditional sense, but a quiet, persistent, unstoppable revolution in how we think about money, about trust, about power. Bitcoin's story is far from over. It continues to evolve, to surprise, to confound expectations. It has survived longer than most people thought it would. It has grown larger than most people imagined. And it has inspired a wave of innovation. Thousands of other cryptocurrencies, each experimenting with different approaches, different trade-offs. Some of these may succeed where Bitcoin has limitations. Some may fail spectacularly. But the genie is out of the bottle. The idea that money can exist outside the control of governments and banks is now part of the collective consciousness. It cannot be unthought. As we look to the future, the question is not whether Bitcoin will replace traditional money. That seems unlikely, at least in the near term. The question is how Bitcoin and other cryptocurrencies will coexist with traditional money, how they will be regulated, how they will be used. Will Bitcoin become a widely accepted store of value, a digital gold held by individuals and institutions as a hedge against uncertainty? Will it find niche uses in remittances, in cross-border payments, in regions with unstable currencies? Will governments adopt elements of Bitcoin's technology, creating their own digital currencies while maintaining central control? Or will Bitcoin fade, eclipsed by newer technologies, remembered as an interesting experiment but ultimately a historical footnote? No one knows. The future is uncertain, but uncertainty is nothing new for Bitcoin. It was born in uncertainty, in the chaos of the worst financial crisis in generations. It has thrived on uncertainty. Each crisis, each crash, each scandal, making it stronger, more battle-tested, more resilient, and it has given people something that was in short supply in 2008 and remains in short supply today. Hope. Hope that there are alternatives. Hope that individuals can have control over their own wealth. Hope that the mistakes of the past do not have to define the future. Whether that hope is justified, whether Bitcoin lives up to its promise, only time will tell. But for now, Bitcoin endures. The network runs, the blockchain grows, and somewhere, in the depth of the night, in the quiet hours when the world seems to pause, someone is downloading the Bitcoin software for the first time, compiling the code, running a node, and the experiment continues. Before we move forward, let us pause and reflect on what we've explored. We have journeyed through the collapse of 2008, through the Cypherpunk movement, through the technical innovations that made Bitcoin possible. We have seen Bitcoin's birth, its early struggles, its cycles of boom and bust. We have considered its vulnerabilities and its strengths, its critics and its champions, and we have tried to understand what Bitcoin means, not just as a technology, but as an idea, as a challenge to the status quo, as a vision of a different kind of future. In the parts to come, we will delve deeper still. We will explore the economic theories that underpin Bitcoin. We will examine the ethical questions it raises. We will consider its environmental impact, its role in financial inclusion, its potential to reshape power structures, and we will listen to the voices of those who've been transformed by Bitcoin, for better or worse. This is a story without an ending, a narrative still being written, and we are all part of it, whether we hold a single Satoshi or whether we have never touched a cryptocurrency in our lives. Because Bitcoin is not just about money, it is about trust, it is about freedom, it is about who gets to decide, who gets to control, who gets to shape the world we live in. And those questions, those deep and difficult questions, are questions we all must answer. Let us now turn our attention to the economics of Bitcoin, to the theories and principles that govern its behavior, that make it not just a technological marvel, but a functioning economic system. Economics, at its heart, is the study of scarcity and choice. How do we allocate limited resources among unlimited wants? What determines value? What mechanisms coordinate the actions of millions of individuals, each pursuing their own interests into a coherent whole? Bitcoin brings a fresh perspective to these ancient questions. It is a form of money designed by computer scientists rather than economists, and it challenges many of the assumptions that have governed monetary policy for the past century. Traditional economic theory holds that a certain amount of inflation is desirable. Central banks target an inflation rate of around 2% per year. The reasoning is that mild inflation encourages spending and investment. If people know their money will be worth less tomorrow, they are incentivized to spend it or invest it today. This keeps money circulating through the economy, which fuels growth. Deflation, the opposite of inflation, where prices fall over time, is considered dangerous. If people expect prices to fall, they will delay purchases, waiting for things to become cheaper. This reduces demand, which causes businesses to cut production and lay off workers, which further reduces demand, creating a downward spiral. The Great Depression of the 1930s was characterized by deflation, and economists have been terrified of it ever since. Bitcoin, however, is inherently deflationary. Its supply is capped at 21 million coins. As more people adopt Bitcoin, as demand increases, the value of each Bitcoin should theoretically rise. This makes Bitcoin attractive as a store of value, but problematic as a currency. Why would you spend a Bitcoin today if you believe it will be worth more tomorrow? This is the paradox of Bitcoin. The very features that make it a good store of value, scarcity, and predictability make it a poor medium of exchange. And yet, proponents argue that this is not a fatal flaw. They point out that in a Bitcoin-based economy, prices would simply be denominated in smaller units. A Bitcoin can be divided into 100 million Satoshis, named after Bitcoin's creator. As the value of a Bitcoin rises, goods and services would be priced in Satoshis rather than whole Bitcoins. A cup of coffee might cost 10,000 Satoshis instead of 0.0001 Bitcoin. The math is the same, but the psychology is different. There is also a philosophical argument here. Proponents of hard money, money with a fixed or predictable supply, argue that inflation is a form of theft. When a central bank creates more money, it dilutes the value of the money already in circulation, Savers, who hold cash, see their purchasing power eroded. Debtors, who owe fixed amounts, benefit because they can repay their loans with cheaper money. This redistribution, critics say, is unfair and economically inefficient. It punishes prudence and rewards borrowing. A deflationary currency like Bitcoin, they argue, would encourage saving, would reward those who delay gratification, and would lead to a more stable and prosperous society. Critics counter that this is naive, that deflation would cripple the economy, that debt, far from being a vice, is essential for growth, allowing businesses to invest and individuals to buy homes and cars they could not otherwise afford. The debate between inflationists and deflationists is not new. It has raged for centuries, taking different forms in different eras. In the late 19th century, it was the debate over the gold standard versus bimetallism. Farmers and debtors, who struggled under deflation caused by the gold standard, wanted the government to mint silver coins, increasing the money supply and causing inflation. Creditors and the financial elite wanted to maintain the gold standard, preserving the value of their wealth. William Jennings Bryan, in his famous Cross of Gold speech in 1896, attacked the gold standard, declaring, "You shall not crucify mankind upon a cross of gold." He lost the presidential election, and the gold standard prevailed. But the underlying tension remained. Bitcoin revives this debate in a new context. It is, in a sense, a digital gold standard, but one that operates outside the control of any government. Another economic concept central to Bitcoin is the idea of sound money. Sound money is money that maintains its value over time, that cannot be debased or manipulated by governments or central banks. Historically, gold was considered sound money. It was scarce, durable, and difficult to produce. Governments could not simply print more gold. But the gold standard was abandoned in the 20th century because it constrained governments' ability to respond to economic crises, to finance wars, to manage unemployment. Fiat currency gave governments flexibility, but at the cost of soundness. Bitcoin attempts to bring back sound money in a digital form. It is scarce by design. Its issuance is predictable and transparent. No one can create more Bitcoins on a whim. For those who believe that sound money is essential for a healthy economy, Bitcoin is a godsend. For those who believe that flexible monetary policy is essential, Bitcoin is a regression, a return to the rigid and destructive monetary systems of the past. Bitcoin also introduces the concept of programmatic monetary policy. In traditional systems, central banks adjust interest rates and the money supply based on economic conditions, attempting to balance growth and inflation. This requires judgment, discretion, the wisdom of central bankers. And as the 2008 crisis showed, that wisdom is not infallible. Bitcoin replaces human judgment with code. The rules are fixed and transparent. Everyone knows how many Bitcoins exist, how many will be created, and when. This eliminates uncertainty, at least regarding the money supply. But it also eliminates flexibility. If the economy enters a recession, if demand collapses, a central bank can lower interest rates, increase the money supply, try to stimulate activity. Bitcoin cannot. Its supply increases at a fixed rate regardless of economic conditions. Supporters say this is a feature, not a bug. It forces individuals and businesses to be prudent, to save for downturns, to not rely on bailouts or inflation to solve their problems. Critics say it is a recipe for disaster, that economic fluctuations are inevitable, and a monetary system that cannot adapt will amplify them. There is also the question of how Bitcoin functions as a unit of account. For money to be useful, people need to be able to price goods and services in it. But Bitcoin's volatility makes this difficult. A merchant who prices an item at 0.001 Bitcoin today might find that the dollar equivalent has changed dramatically by tomorrow. This is why most businesses that accept Bitcoin immediately convert it to dollars or euros. They are using Bitcoin as a payment rail, a way to move value, but not as a unit of account. The price is still set in fiat currency. Bitcoin is just a middleman. For Bitcoin to truly function as money, this would need to change. People would need to think in Bitcoin, to have an intuitive sense of what a Bitcoin is worth, to price their labor and their goods in Bitcoin rather than translating back to dollars. This shift would require a level of adoption and stability that Bitcoin has not yet achieved and may never achieve. Let us consider also the role of mining in Bitcoin's economy. Mining serves two purposes. It creates new Bitcoins, distributing them to those who contribute computational power to the network, and it secures the network, ensuring that transactions are validated and that the blockchain cannot be tampered with. Miners are rewarded with newly created Bitcoins, the block reward, and with transaction fees paid by users. But the block reward decreases over time, halving every 4 years. Eventually, around the year 2140, the block reward will reach zero. No new Bitcoins will be created. At that point, miners will be compensated entirely through transaction fees. The question is whether transaction fees alone will be sufficient to incentivize miners to continue securing the network. If not, the network could become vulnerable to attack. If fees rise too high to compensate miners, Bitcoin could become too expensive to use. This is a long-term challenge, and no one knows how it will be resolved. Some believe that by the time the block reward runs out, Bitcoin will be so valuable and widely used that transaction fees will be more than enough. Others are less certain. Mining also raises questions of fairness and distribution. In the early days, anyone with a computer could mine Bitcoin. But as the network grew, as the difficulty increased, mining became professionalized. Today, it requires specialized hardware, ASICs, application-specific integrated circuits, designed solely for the purpose of mining Bitcoin. These machines are expensive and consume vast amounts of electricity. Mining is now dominated by large operations, mining farms in regions with cheap electricity. The individual hobbyist has been priced out. This concentration of mining power worries some people. If a small number of entities control most of the mining, they could potentially collude, could manipulate the network. So far this has not happened, but the risk is real. Bitcoin's decentralization, its lack of central control, is its greatest strength. But if mining becomes too concentrated, that decentralization could be undermined. The environmental impact of mining is another contentious issue. Bitcoin mining consumes as much electricity as some countries. Critics say this is wasteful, that it contributes to climate change, that a system which requires burning fossil fuels to create digital money is fundamentally unsustainable. Proponents make several counter-arguments. First, they note that much of the electricity used in mining comes from renewable sources. Miners seek out the cheapest electricity, and in many regions that means hydroelectric power, geothermal energy, or stranded natural gas that would otherwise be flared. Second, they argue that Bitcoin's energy consumption is a feature, not a bug. It is the cost of security, the proof of work that makes the network tamper-proof. Traditional financial systems also consume energy in the form of bank branches, data centers, armored trucks, all the physical and digital infrastructure required to move and secure money. When you account for all of that, Bitcoin's energy consumption may not be so disproportionate. Third, They point out that energy consumption is not the same as carbon emissions. If mining is powered by clean energy, its environmental impact is minimal, and the mere existence of Bitcoin creates demand for cheap, clean energy, incentivizing the development of renewable power sources. But the environmental debate is far from settled. Some countries have banned or restricted Bitcoin mining because of energy concerns. China, which once hosted the majority of Bitcoin mining, banned it in 2021, citing environmental and financial risks. Miners relocated to other countries, primarily the United States, Kazakhstan, and Russia. This dispersion reduced the concentration of mining power, which was a positive development for decentralization. But it also highlighted Bitcoin's vulnerability to regulatory action. Governments have the power to make mining difficult or impossible within their borders, and if enough governments coordinated, they could cripple the network, though Bitcoin would likely survive in some form, operating in jurisdictions where it remains legal or tolerated. Let us turn now to the question of financial inclusion, one of the most compelling arguments in favor of Bitcoin. There are an estimated 1.7 billion people in the world who do not have access to traditional banking services. They are unbanked, either because there are no banks in their region or because they do not have the documentation or resources required to open an account. These people are excluded from the global financial system. They cannot easily save money, cannot access credit, cannot participate in international trade. For them, Bitcoin offers a lifeline. All you need to use Bitcoin is a smartphone and an internet connection. You do not need to provide identification, do not need to prove your address or your income. You can download a Bitcoin wallet, receive Bitcoins, send them to anyone in the world. This is revolutionary. It gives financial agency to people who've been marginalized and excluded. But the reality is more complicated. Bitcoin's volatility makes it a risky store of value for people who cannot afford to lose money. Transaction fees, during times of high network congestion, can be prohibitively expensive, eating up a significant portion of a small transaction. The technical knowledge required to use Bitcoin safely, to secure your private keys, to avoid scams, is beyond the reach of many people, especially those with limited education or digital literacy. And internet access, while spreading, is not universal. In many parts of the world, connectivity is expensive, unreliable, or non-existent. So while Bitcoin has the potential to promote financial inclusion, realizing the potential requires overcoming significant barriers. It requires education, infrastructure, and solutions to reduce costs and increase usability. There are efforts underway to address these challenges. The Lightning Network, a Layer 2 solution built on top of Bitcoin, enables fast, cheap transactions by moving them off the main blockchain and settling them later. This makes Bitcoin more practical for everyday use, for small purchases, for microtransactions. Mobile wallets and apps are being developed to make Bitcoin more user-friendly, to abstract away the technical complexity. Community education initiatives are teaching people in developing countries how to use Bitcoin, how to protect their funds, how to avoid scams. And in some regions, Bitcoin is already making a difference. In countries like Venezuela and Argentina, where hyperinflation has destroyed the local currency, people are turning to Bitcoin to preserve their wealth. In El Salvador, where remittances make up a significant portion of the economy, Bitcoin offers a cheaper alternative to traditional money transfer services, which charge high fees. But Bitcoin is not a panacea. It cannot by itself solve the deep structural problems that create poverty and exclusion. It cannot build roads or schools or hospitals. It cannot end corruption or establish the rule of law. What it can do is provide a tool, a means of transacting and storing value that is accessible, that does not require permission, that cannot be easily confiscated or controlled. Whether that tool is used for good or ill depends on the people who wield it. And that is true of any technology. The internet can be used to spread knowledge or to spread lies. Smartphones can empower or addict. Bitcoin is no different. It is a tool. Its impact will be determined by how we choose to use it. There is also the question of Bitcoin's relationship to traditional financial institutions. Initially, Bitcoin was seen as a threat, a competitor to banks and payment processors, and in some ways, it is. Bitcoin allows people to be their own bank, to hold and transfer value without intermediaries. But over time, traditional institutions have begun to adapt. Some have embraced Bitcoin, offering custody services, allowing customers to buy and sell Bitcoin through their platforms, even investing in Bitcoin themselves. Banks like Goldman Sachs, JP Morgan, and Fidelity have created cryptocurrency trading desks. PayPal and Square allow users to buy, sell, and hold Bitcoin. Institutional investors, hedge funds, family offices are allocating portions of their portfolios to Bitcoin. This institutional adoption brings legitimacy. It signals that Bitcoin is not just a fringe movement, but a serious asset. But it also raises concerns. If Bitcoin becomes dominated by large institutions, if it is integrated into the existing financial system, does it lose its revolutionary potential? Does it become just another asset, another tool for the wealthy to accumulate more wealth? There are different visions for Bitcoin's future, and they are not all compatible. Some see Bitcoin as a hedge, a form of insurance against the collapse of fiat currency. They buy it and hold it, hoping they never need to use it, but comforted by the knowledge that if the system fails, they have an alternative. Others see Bitcoin as a tool for individual sovereignty, a way to opt out of surveillance capitalism, to transact privately, to preserve freedom in an increasingly monitored world. Still others see Bitcoin as an investment, a speculative asset that will make them wealthy. They buy low, sell high, and care little about the philosophy behind it. And some see Bitcoin as a stepping stone, the first in a long line of cryptocurrencies that will each serve different purposes, that will collectively transform how we interact with money and with each other. Perhaps all of these visions are valid. Perhaps Bitcoin can be many things to many people. One of its strengths is that it is permissionless. You do not need anyone's approval to use it. You can use it however you see fit. But this plurality of visions also creates tension. Hard decisions must be made about how Bitcoin should evolve, and those decisions are contentious because different groups have different priorities. Developers must balance security with usability, decentralization with scalability. Miners must balance profitability with the health of the network. Users must balance the desire for privacy with the need for regulatory compliance. And all of these groups must somehow coordinate, must somehow reach consensus without a central authority to impose a solution. This is governance by rough consensus, and it is messy, slow, frustrating. But it is also resilient. It ensures that no single person or group can hijack Bitcoin for their own purposes. Changes to the protocol require widespread agreement, which means that only changes that clearly benefit the network as a whole are likely to be adopted. This conservatism frustrates those who want Bitcoin to move faster, to compete more aggressively with traditional payment systems or with newer cryptocurrencies. But it reassures those who value stability, who believe that the most important characteristic of money is predictability. Let us consider now the psychological dimensions of Bitcoin. Money is not just an economic tool, it is deeply intertwined with identity, with values, with how we see ourselves and our place in society. The choice to use Bitcoin is, for many people, a statement. It says something about who you are, what you believe. It says that you value independence over convenience, that you distrust centralized authority, that you're willing to take responsibility for your own financial security. Or it says that you are an early adopter, someone who embraces new technology, who is willing to take risks. Or it says that you are a rebel, someone who rejects the status quo, who wants to build a different kind of world. This identity dimension is powerful. It creates communities, brings people together who share a common vision. The Bitcoin community is passionate, vocal, sometimes evangelical. They attend conferences, participate in online forums, create content explaining and promoting Bitcoin. They see themselves as part of a movement, not just users of a technology. But this passion can also be polarizing. It can lead to tribalism, to an us versus them mentality. Bitcoiners sometimes dismiss critics as ignorant or corrupt, as defenders of a broken system. Critics sometimes dismiss Bitcoiners as naive idealists or greedy speculators, as people who have drunk the Kool-Aid. The truth, as always, is more nuanced. There are legitimate criticisms of Bitcoin, and there are legitimate reasons to be enthusiastic about it. Both perspectives have merit. There is also a psychological tendency called the endowment effect, where people value things more highly once they own them. If you buy Bitcoin, you become invested, not just financially but emotionally. You want it to succeed, and you interpret information in ways that confirm your decision. You pay attention to positive news and dismiss negative news. This is a natural human bias, but it can lead to poor decision-making. It can prevent you from seeing risks, from adjusting your strategy when circumstances change. The same bias affects critics. If you have publicly criticized Bitcoin, if you have staked your reputation on the claim that it will fail, you have an incentive to continue believing that, even if the evidence starts to suggest otherwise. Awareness of these biases is important. It allows us to think more clearly, to evaluate Bitcoin on its merits, rather than through the lens of our preconceptions or our investments. And it reminds us that the debate over Bitcoin is not just about facts and logic. It is about emotions, about values, about what kind of world we want to live in. These are questions that cannot be answered by data alone. They require judgment, wisdom, a willingness to consider perspectives different from our own. Let us turn now to the ethical questions raised by Bitcoin. Is it morally acceptable to use a currency that can be used for illegal activities? Is it responsible to invest in an asset that consumes vast amounts of energy? Is it fair that early adopters of Bitcoin have become extraordinarily wealthy, while latecomers may never see the same gains? These are difficult questions, and there are no easy answers. Let us consider each in turn. First, the use of Bitcoin for illegal activities. It is true that Bitcoin has been used to buy drugs, to pay for ransomware, to launder money. But it is also true that the vast majority of illegal transactions still happen in cash, in dollars and euros. The proportion of Bitcoin transactions that are illicit is small and declining as the network matures and as law enforcement develops better tools to trace Bitcoin transactions. Moreover, the anonymity that Bitcoin provides is not absolute. Every transaction is recorded on the blockchain, and with enough effort, investigators can often link addresses to real-world identities. Cash, by contrast, is truly anonymous. Once you hand someone a $100 bill, there is no record of the transaction. The question, then, is whether the potential for misuse outweighs the benefits of financial privacy and freedom. Privacy is a fundamental right, recognized in international human rights declarations. The ability to transact without surveillance is important for journalists, for activists, for people living under authoritarian regimes. It is also important for ordinary people who simply do not want every purchase they make to be tracked and analyzed by corporations and governments. The fact that some people misuse privacy does not mean that privacy itself is wrong. We accept that cash can be used for illegal purposes, but we do not ban cash. The same logic should apply to Bitcoin. Second, the environmental impact. This is a more difficult question. Climate change is an existential threat, and every ton of carbon dioxide we emit brings us closer to catastrophe. If Bitcoin mining contributes significantly to emissions, that is a serious moral problem. But the question is not whether Bitcoin uses energy. It is whether the energy it uses is justified by the benefits it provides. All human activities use energy. Agriculture, transportation, manufacturing, entertainment, all of it requires energy. We do not object to these activities simply because they use energy. We ask whether they provide value, whether that value justifies the cost. So what value does Bitcoin provide? For people in stable, wealthy countries with access to reliable banking, Bitcoin may seem like a luxury, a speculative investment. But for people in countries with hyperinflation, with capital controls, with corrupt or incompetent governments, Bitcoin can be a lifeline. It can preserve wealth, facilitate trade, provide financial access. Is that value worth the energy cost? Reasonable people can disagree, but it is important to recognize that the question is not black and white. It is a trade-off, and different people with different circumstances and different values will weigh that trade-off differently. Moreover, the energy problem is not insurmountable. If Bitcoin mining is powered by renewable energy, if it incentivizes the development of solar, wind, and geothermal power, then its environmental impact is minimal, and there are already signs that this is happening. Miners are increasingly seeking out renewable energy sources because they are cheap and because there is growing social pressure to reduce carbon emissions. Some Bitcoin advocates even argue that Bitcoin can help stabilize renewable energy grids by providing a flexible source of demand that can absorb excess power when the sun is shining or the wind is blowing. Whether this vision will be realized remains to be seen, but it is a possibility and it should not be dismissed out of hand. Third, the question of fairness. Satoshi Nakamoto, whoever he or she or they are, is estimated to own around 1 million bitcoins, worth tens of billions of dollars at current prices. Early adopters, people who bought Bitcoin when it was worth pennies, have become wealthy beyond imagination. Is this fair? Did they do anything to deserve such wealth? They took a risk, yes. They believed in an idea when almost no one else did. But luck also played a role. They happened to hear about Bitcoin at the right time. They happened to have the resources and the inclination to invest, and now they are rich, while others who are just as smart, just as hardworking, will never have the same opportunity. This is a feature of any new technology or asset. Early adopters reap disproportionate rewards. The first investors in Amazon, in Google, in Apple made fortunes. Those who invest today can still profit, but not to the same degree. Is this unfair? Or is it simply the nature of innovation, the reward for being willing to take risks before the outcome is certain? Economic systems always create winners and losers. The question is whether the system as a whole is just, whether it provides opportunities for people to improve their lives, whether it rewards effort and innovation. Bitcoin, like any system, is imperfect, It has created new inequalities even as it promises to address old ones. But it has also created opportunities for people who are excluded from the traditional financial system, and it has demonstrated that alternatives are possible, that we are not locked into the systems we have inherited. These ethical questions do not have definitive answers. They require each of us to think carefully about our values, about what we believe is important, about what kind of world we want to create. Bitcoin is a tool. Like any tool, it can be used for good or ill. It can empower or exploit. It can liberate or enslave. The outcome depends on us, on the choices we make individually and collectively. As we move deeper into our exploration, let us pause and consider the broader historical context. Bitcoin did not emerge in a vacuum. It is part of a longer story, a story about humanity's relationship with money, with trust, with power. For as long as civilizations have existed, people have sought ways to store and transfer value. And for as long as money has existed, there have been conflicts over who controls it and how it should be managed. Bitcoin is the latest chapter in this ancient story. And to understand its significance, we must understand what came before. In the earliest human societies, there was no money. People lived in small groups, and resources were shared. If you killed a deer, you shared the meat with your tribe. If your neighbor's hut burned down, you helped them rebuild. This gift economy worked because everyone knew everyone else. Reputation mattered. If you were generous, others would be generous to you. If you were selfish, you would be ostracized. But as societies grew larger, as people began to interact with strangers, the gift economy became impractical. You could not keep track of who owed what to whom, and so barter emerged. I will give you my grain in exchange for your cloth. But barter, as we've discussed, has limitations. It requires a double coincidence of wants. And so money was invented. The first forms of money were commodities that everyone valued: shells, beads, cattle, salt. These were useful in themselves and also served as a medium of exchange. But they had drawbacks. Cattle could die, salt could dissolve, shells could break. And so metals, particularly gold and silver, became the preferred form of money. They were durable, divisible, portable, and universally desired. For thousands of years, gold was money. Empires rose and fell, but gold remained. It was the constant, the anchor, the measure of value. But gold also had limitations. It was heavy. It could be stolen, and its supply was limited, which sometimes led to deflation and economic stagnation. Paper money was invented as a convenient substitute for gold. Instead of carrying gold, you carried a piece of paper that represented gold. This worked as long as people trusted that the paper could be redeemed for gold. But over time, governments realized that they did not need to hold gold for every piece of paper they issued. They could issue more paper than they had gold, as long as not everyone tried to redeem their paper at once. This is fractional reserve banking, and it allowed economies to grow faster than they would have under a strict gold standard. But it also introduced risk. If confidence was lost, if people rushed to redeem their paper for gold, the system could collapse. This is a bank run, and history is full of them. In the 20th century, the link between paper money and gold was gradually severed. First during the World Wars, when governments needed to print money to finance their military efforts. Then in the 1930s, during the Great Depression, when countries abandoned the gold standard to give themselves more flexibility to fight deflation. And finally in 1971, when President Nixon ended the dollar's convertibility to gold. From that point on, money became entirely fiat. backed not by gold but by the authority of the government and the faith of the people. This system has worked, more or less, for the past 50 years. But it has also led to concerns about inflation, about government overreach, about the erosion of purchasing power. Bitcoin represents a return to the principles of hard money, but in a digital form. Like gold, Bitcoin has a fixed supply. It cannot be debased or inflated by governments. But unlike gold, Bitcoin is perfectly portable, infinitely divisible, and can be transferred across the world in minutes. It combines the best features of gold and digital technology. This is why some people call it digital gold. But Bitcoin also introduces something new, something that was not possible with gold or any previous form of money. It is programmable. It is money that can be governed by code, by rules that are transparent and unchangeable. This programmability opens up possibilities that we are only beginning to explore. Consider smart contracts, programs that execute automatically when certain conditions are met. If you want to send money to someone only if a particular event occurs, you can write a smart contract to do that. No need for a lawyer or a bank to verify the conditions. The code does it. This is the idea behind Ethereum, a cryptocurrency that was launched in 2015, inspired by Bitcoin but designed to be more flexible, more programmable. Ethereum and other cryptocurrencies have expanded the vision of what digital money can be. They have shown that blockchain technology can be used for more than just currency, for decentralized applications, for digital identity, for supply chain management, for voting systems, for all kinds of uses that require trust and verification without central control. But Bitcoin remains the most secure, the most decentralized, the most proven of all cryptocurrencies. It is the gold standard of digital money. Other cryptocurrencies may be faster, may have lower fees, may offer more features, but none have Bitcoin's track record, its security, its network effect. Bitcoin has been running continuously for more than 15 years. It has survived attacks, crashes, scandals, regulatory crackdowns. It has been declared dead hundreds of times, yet it endures. This resilience is its greatest asset. It is why people trust Bitcoin, why they are willing to hold it as a store of value. And as long as that trust remains, Bitcoin will continue to exist. Let us consider also the geopolitical implications of Bitcoin. Money has always been a tool of power. The country that controls the world's reserve currency, currently the United States with the dollar, has enormous influence. It can impose sanctions, freeze assets, control access to the global financial system. This power can be used for good, to punish rogue states, to prevent terrorist financing. But it can also be abused, used to advance narrow national interests at the expense of others. Bitcoin offers an alternative. It is money that exists outside the control of any nation. It cannot be sanctioned. It cannot be frozen, at least not without the owner's private keys. This makes it attractive to countries and individuals who are excluded from the dollar-based system. Russia, Iran, Venezuela, North Korea, all have explored using Bitcoin and other cryptocurrencies to evade sanctions. China, before it banned mining, was concerned that Bitcoin could be used to circumvent capital controls, allowing wealthy Chinese citizens to move money out of the country. The United States and other Western countries are concerned that Bitcoin could undermine their ability to enforce sanctions and combat illicit finance. These are legitimate concerns, but they also reveal a deeper tension. The current global financial system is based on the hegemony of a few powerful countries, particularly the United States. Bitcoin challenges that hegemony. It offers a neutral alternative, a form of money that does not favor any nation or bloc. Whether this is a good thing or a bad thing depends on your perspective. From the perspective of the United States and its allies, Bitcoin is a threat. It reduces their leverage, their ability to impose their will on others. From the perspective of countries that are outside the Western orbit, Bitcoin is an opportunity. It allows them to participate in global trade without submitting to American dominance. And from the perspective of individuals, particularly those living under authoritarian regimes, Bitcoin is a tool of freedom. It allows them to preserve their wealth, to transact, to escape the control of their government. These competing interests will shape the future of Bitcoin. Governments will try to regulate it, to control it, to integrate it into the existing system. Users will try to preserve its decentralized, permissionless nature. The outcome is uncertain. There is also the question of central bank digital currencies, or CBDCs. In response to the rise of Bitcoin and other cryptocurrencies, many governments are exploring the idea of creating their own digital currencies. A CBDC would be like a digital version of cash, issued and controlled by the central bank. It would combine the efficiency of digital payments with the stability and backing of fiat currency. China is leading the way with its digital yuan, which is already being tested in several cities. The European Central Bank, the Federal Reserve, and central banks in dozens of other countries are researching CBDCs. But CBDCs are fundamentally different from Bitcoin. They are centralized. The central bank controls the supply, can monitor all transactions, can freeze accounts, can impose rules on how the currency is used. A CBDC is a tool of state control, whereas Bitcoin is a tool of individual sovereignty. Some people fear that CBDCs could lead to unprecedented levels of surveillance and control. If all transactions are digital and monitored by the government, privacy disappears. The government could know everything you buy, everywhere you go, everyone you transact with. It could impose negative interest rates, forcing you to spend rather than save. It could program the money to expire, to only be usable for certain purchases, to be confiscated if you engage in disapproved activities. These are dystopian scenarios, but they are not far-fetched. The technology to do all of this exists. Whether it will be used that way depends on the political and legal frameworks that govern CBDCs. Bitcoin, by contrast, offers an escape from this surveillance state. It offers privacy, autonomy, the ability to transact without permission. This is why some people see Bitcoin as a hedge, not just against economic instability, but against political instability, against the erosion of civil liberties. It is a form of insurance, a backup plan, a way to preserve freedom in an increasingly controlled world. This narrative resonates with people across the political spectrum. Libertarians who distrust government on principle. Liberals who are concerned about mass surveillance and the abuse of power. Authoritarians who want to circumvent the sanctions and restrictions imposed by democratic governments. Bitcoin is a tool that can be used by anyone for any purpose. It is neutral, amoral, indifferent to the intentions of its users. This neutrality is both its strength and its challenge. Let us return now to the human stories, the individuals whose lives have been touched by Bitcoin. Because for all the technical details and economic theories, Bitcoin is ultimately about people. It is about their hopes and fears, their dreams and struggles. Consider the story of a Venezuelan family living through hyperinflation so severe that prices double every few weeks. The currency, the bolivar, is worthless. People carry stacks of bills to buy a loaf of bread. Savings evaporate overnight. The elderly living on pensions cannot afford food or medicine. The government, incompetent and corrupt, prints more money to cover its debts, making the problem worse. In this environment, Bitcoin is a lifeline. Even though it is volatile, it is far more stable than the Bolivar. People convert their earnings to Bitcoin as quickly as possible, preserving at least some of their purchasing power. They use Bitcoin to buy goods online, to receive remittances from relatives abroad to escape the economic chaos. Or consider the story of a journalist in Belarus covering protests against the authoritarian government. The government freezes her bank account, cutting off her access to money, hoping to silence her. But she has Bitcoin. She cannot be stopped. She continues her work, accepting donations in Bitcoin from supporters around the world. The government cannot freeze Bitcoin. It cannot confiscate it without her private keys. Bitcoin gives her the freedom to continue speaking truth to power. These stories are real. They're happening right now in countries around the world. And they illustrate the power of Bitcoin not as a speculative asset, not as a get-rich-quick scheme, but as a tool of human dignity and freedom. But there are also stories of loss, of people who have been hurt by Bitcoin. Consider the story of a young man who invested his life savings in Bitcoin at the peak of the 2017 bubble. He bought at $20,000, convinced that it would go to $100,000 to $1 million. When the price crashed, he lost everything. He fell into depression, struggled to rebuild his life. Or consider the story of someone who lost their private keys, who locked away their Bitcoin and then forgot the password, losing access to what would now be a fortune. Or the victims of scams, of Ponzi schemes that used Bitcoin's complexity and mystique to lure in unsophisticated investors. These stories are also real. Bitcoin is not a panacea. It does not solve all problems, and it creates new problems, new risks, new ways to fail. The challenge is to learn from both kinds of stories, to understand Bitcoin's potential and its limitations, to use it wisely, cautiously, with an awareness of the risks, and to work towards a future where the benefits of Bitcoin are accessible to more people, where the barriers to entry are lower, where the technology is more user-friendly, where the risks are better understood and managed. This will require education, infrastructure, regulation that protects consumers without stifling innovation. It will require a collective effort involving developers, businesses, governments, and users. And it will require time. Bitcoin is still young, it is still evolving, and its ultimate impact on society is still being determined. As we approach the conclusion of our journey, let us reflect on what we have learned. We began with a question. Why did Bitcoin start during a financial crisis? And we have seen that the answer is multifaceted. Bitcoin started during the crisis because the crisis revealed the need for an alternative, a form of money that could not be manipulated by governments or banks. It started because the technical pieces were in place, because the cypherpunks had spent decades developing the ideas and tools that made Bitcoin possible. It started because someone, Satoshi Nakamoto, saw the moment and seized it, creating something that was both revolutionary and inevitable. And it started because people were ready to believe, ready to try something new, ready to take a chance on a vision of a different kind of future. But Bitcoin's story does not end with its creation. It is a story that is still unfolding, a story in which we are all participants. Whether we hold Bitcoin or not, whether we support it or criticize it, we are all affected by it. Bitcoin has changed the conversation about money, about trust, about power. It has forced governments and central banks to rethink their assumptions. It has inspired a wave of innovation in financial technology. It has given hope to millions of people who were excluded from the traditional financial system. and it has raised difficult questions about privacy, about regulation, about the role of technology in society. These questions do not have easy answers. They require ongoing dialogue, experimentation, adaptation. Bitcoin is an experiment in collective governance, in decentralized coordination, in trustless trust. It is a test of whether people can cooperate, can reach consensus without a central authority to enforce the rules. So far, the experiment has been remarkably successful. Bitcoin has survived and thrived despite constant challenges. But the experiment is not over. The future will bring new challenges, new opportunities, new crises, and Bitcoin will need to adapt, to evolve, to prove itself again and again. Whether it will succeed in the long term, no one knows. But the fact that it has come this far, that it has endured when so many predicted its demise, is itself remarkable. And so we arrive at the end of our journey together, though the story of Bitcoin continues. Let us take a moment to breathe, to let everything we have explored settle into place. We have travelled through time, through crisis, through innovation and struggle. We have met the dreamers who imagined a world where privacy and freedom could be protected through mathematics. We have witnessed the collapse of financial empires built on sand. We have seen Bitcoin born in the aftermath, a quiet rebellion encoded in the Genesis block, and we have followed its path from obscurity to prominence, through cycles of boom and bust, through scandal and triumph, through doubt and vindication. What can we say now, at the end of this exploration? What wisdom can we carry forward? Perhaps the most important lesson is this: the systems we inherit, the institutions we trust, are not permanent. They are human creations, and they can fail. The 2008 financial crisis was a reminder of this truth. The banks failed, the regulators failed, the rating agencies failed, the experts who claimed to understand the system, who promised that everything was under control, they failed too. And millions of people paid the price. Their homes, their savings, their futures, all swept away in a cascade of bad decisions and systemic fragility. Bitcoin emerged from that failure, from that loss of faith. It offered an alternative, a vision of money that did not depend on trust in institutions, but on trust in mathematics, in code, in the collective wisdom of a decentralized network. It was a radical idea, and it remains radical today, because it challenges the very foundation of how we organize society, how we coordinate economic activity, how we allocate power and resources. It says that we do not need central banks, do not need governments, do not need banks to manage money. We can manage it ourselves, collectively, through a system that is transparent, predictable, and uncensorable. This vision appeals to some and terrifies others, and both responses are understandable, because Bitcoin is not just a technology, it is a statement about values, about what we believe is important. If you value freedom above all, if you distrust authority, if you believe that individuals should be sovereign over their own wealth, then Bitcoin resonates. It is a tool that aligns with your values. But if you value stability, if you believe that governments have a responsibility to manage the economy, to protect consumers, to ensure that money is used for legitimate purposes, then Bitcoin is problematic. It seems like a threat to the social order, a tool that could be used for harm. Both perspectives have merit. The world is complex and there are trade-offs in every choice we make. Bitcoin offers benefits, but it also comes with costs. It provides freedom, but that freedom can be abused. It creates opportunities, but it also creates risks. The question is not whether Bitcoin is good or bad in some absolute sense. The question is how we can maximize its benefits while minimizing its harms. how we can harness its potential for financial inclusion, for privacy, for resistance to censorship, while addressing concerns about its environmental impact, its use in illicit activities, its volatility. These are not easy questions, and they do not have simple answers. They require nuance, compromise, ongoing dialogue. One thing is certain: Bitcoin has opened a door that cannot be closed. Even if Bitcoin itself were to fail, even if it were to be superseded by a newer, better cryptocurrency, the idea would remain. The idea that money can exist outside the control of governments and banks. The idea that trust can be established through cryptography rather than through institutions. The idea that individuals can be sovereign, can control their own wealth, can transact freely without asking permission. These ideas are now part of the collective consciousness. They have been tested, proven to some extent, shown to be viable, and they will continue to inspire innovation, to challenge the status quo, to push the boundaries of what is possible. Bitcoin is also a reminder of the power of ideas. Satoshi Nakamoto, whoever they are, changed the world with a 9-page white paper and some code. They did not have an army. They did not have wealth or political power. They had an idea, and they shared it with the world. And that idea has grown, has spread, has inspired millions of people. This is the power of open source, of decentralization, of collaboration. No single person or entity controls Bitcoin. It belongs to everyone and to no one. It is a commons, a public good, a gift to humanity. Whether we choose to accept that gift, and how we choose to use it, is up to us. As we look to the future, what can we expect? Will Bitcoin replace fiat currency? Probably not, at least not in the near term. Governments are too powerful, too entrenched. They will not give up control over money without a fight. And most people, for most purposes, will continue to use fiat currency because it is familiar, because it is stable, because it is accepted everywhere. But Bitcoin does not need to replace fiat currency to be successful. It can coexist, can serve as an alternative, a hedge, a tool for specific use cases. It can be digital gold, a store of value for those who want protection against inflation and instability. It can be a payment rail for cross-border transactions, faster and cheaper than traditional wire transfers. It can be a tool for freedom, for people living under oppressive regimes or dealing with dysfunctional financial systems. Will Bitcoin's price continue to rise? History suggests that it will over the long term, with significant volatility along the way. Each cycle has seen higher highs and higher lows. Each halving has been followed by a bull market, though past performance is no guarantee of future results. As more people adopt Bitcoin, as institutional investors allocate more capital to it, as its utility increases, demand should rise, and with a fixed supply, rising demand means rising prices, but there will be crashes, bear markets, periods of doubt and despair. This is the nature of any emerging asset, any new technology. The path is not smooth. It is jagged, unpredictable, filled with setbacks and surprises. Will governments ban Bitcoin? Some already have, or have tried to. China banned cryptocurrency trading and mining in 2021, though Bitcoin continues to be used there through underground channels. India has considered a ban but has not yet implemented one. The United States has taken a more cautious approach, regulating cryptocurrency exchanges and transactions, but not banning Bitcoin itself. Most democratic countries are unlikely to ban Bitcoin outright, because such a ban would be difficult to enforce and would drive the activity underground. But they will regulate it, will require exchanges to verify customer identities, will impose reporting requirements, will tax capital gains. This regulatory framework will shape how Bitcoin is used, will determine whether it remains primarily a speculative asset or becomes more widely adopted as a medium of exchange. Will new technologies make Bitcoin obsolete? Possibly. Quantum computing could, in theory, break the cryptographic algorithms that secure Bitcoin. But developers are already working on quantum-resistant cryptography, and Bitcoin's protocol can be updated if necessary. Other cryptocurrencies offer features that Bitcoin lacks: faster transactions, lower fees, more privacy, more programmability. But none have matched Bitcoin's security, its decentralization, its network effect. Bitcoin is the most secure blockchain in existence. It has the most miners, the most nodes, the most users. This makes it the most resistant to attack, the most reliable. And in the world of money, reliability is paramount. People trust Bitcoin because it has proven itself over more than 15 years. New cryptocurrencies may be exciting, may have innovative features, but they have not yet earned that trust. The future of Bitcoin will be shaped by many factors: technological developments, regulatory decisions, economic conditions, geopolitical events, cultural shifts, and the choices made by millions of individuals. Will you use Bitcoin? Will you hold it as an investment, as a hedge, as a statement of values? Will you accept it in your business? Will you learn about how it works, or will you dismiss it as a fad? These choices, aggregated across billions of people, will determine Bitcoin's trajectory. No one can predict the future with certainty, but we can prepare for different scenarios, can think through the possibilities, can make informed decisions based on our values and our understanding of the world. Bitcoin's journey began during a financial crisis, born from a loss of faith in the institutions that were supposed to protect us. It offered a vision of something different, something better, a form of money that could not be manipulated, that could not be controlled, that put power back in the hands of individuals. Whether that vision will be fully realized, only time will tell. But Bitcoin has already achieved something remarkable. It has survived. It has grown. It has inspired a global movement. It has forced us to question assumptions we took for granted. And it has shown that alternatives are possible, that the systems we have are not inevitable, that we have the power to create something new. And so, as we close this chapter, as we let the story settle into silence, let us carry forward this understanding. Money is not neutral. It is a tool of power, a mechanism of control, a reflection of our values. The money we use shapes the world we live in. Fiat currency gives power to governments, allows them to manage the economy, but also allows them to debase the currency, to inflate away debts, to surveil and control. Gold gives power to those who possess it, offers stability but limits flexibility, makes the system rigid. Bitcoin gives power to individuals, offers freedom and privacy, but comes with volatility and risks. There is no perfect system. Every choice involves trade-offs. The question is what trade-offs we're willing to accept, what we value most, what kind of world we want to create. Bitcoin is a tool, a powerful tool, a tool that can be used for liberation or exploitation, for empowerment or speculation, for building or destroying. The outcome depends on us, on our choices, on our wisdom, on our willingness to think critically, to question authority, to take responsibility for our own lives and for the society we build together. The financial crisis of 2008 was a failure of responsibility. Those who held power, who made the decisions, did not act responsibly. They prioritized short-term profits over long-term stability. They privatized gains and socialized losses, and millions of people suffered. Bitcoin offers a different model, a model where responsibility is distributed, where no single person or entity has absolute power, where the rules are transparent and enforced by mathematics rather than by fallible human institutions. It is an imperfect model, to be sure, but it is an alternative, and the existence of alternatives is essential for freedom, for progress, for hope. Because if we believe that there is only one way, only one system, only one path forward, then we are trapped, we are powerless. But if we believe that alternatives exist, that we can imagine and create different systems, then we have agency, we have the power to shape our own future. This is the deepest significance of Bitcoin. Not the price, not the technology, not the potential for profit, but the proof that alternatives are possible. The demonstration that ordinary people working together can create something that challenges the most powerful institutions in the world. The reminder that power does not have to flow from the top down, that it can be distributed, decentralized, democratized. Bitcoin is an act of imagination, a belief that the world can be different, a commitment to building that different world, one block at a time. And so we return to where we began, to that quiet moment in January 2009, to that message embedded in the Genesis block. The Times, 03 Jan 2009, Chancellor on brink of second bailout for banks. It was a timestamp, yes, but it was also a declaration, a statement that the old system had failed and that something new was beginning. A quiet rebellion, encoded in mathematics, launched into the digital void. And from that small beginning, a global movement has grown. Millions of people, across hundreds of countries, united by a shared belief in the possibility of a better system. A system built on transparency, on decentralization, on the empowerment of individuals. The journey is not over. Bitcoin's story continues to unfold. New challenges will arise. New crises will test the system. New opportunities will emerge, and we will all play a role in shaping what comes next. Whether we choose to engage directly, to buy and hold Bitcoin, to mine, to develop, to advocate, or whether we choose to observe, to critique, to wait and see. We are all part of this moment, this inflection point in the history of money and power and trust. Let us move forward with wisdom, with humility, with an openness to learning and adapting. Let us question our assumptions, challenge our biases, seek truth wherever it leads. Let us remember the lessons of the 2008 crisis, the cost of unchecked power, the fragility of systems built on trust without verification. And let us carry forward the vision that Bitcoin represents, not as a dogma, not as a certainty, but as a possibility that we can build systems that serve people rather than controlling them, that we can create money that preserves value rather than eroding it, that we can establish trust without relying on fallible institutions. This is the promise of Bitcoin, not guaranteed, but possible. And possibility, in a world often dominated by cynicism and despair, is a precious gift. It is hope. It is agency. It is the belief that we are not powerless, that we can shape our own destiny, that the future is not predetermined but is created by the choices we make today. So let us choose wisely. Let us choose with courage. Let us choose with compassion. And let us build together a world that is more free, more fair, more human. The crisis that gave birth to Bitcoin was a moment of reckoning, a moment when the illusions were stripped away and we saw the system for what it really was: fragile, corrupt, unjust. And in that moment of darkness a light appeared, a small light, flickering, uncertain, but a light nonetheless. Bitcoin, a hope, an alternative, a beginning. And though the path ahead is unclear, though the challenges are many, though the outcome is uncertain, we move forward, we build, we believe, and we trust, not in institutions, not in authorities, but in each other, in the collective wisdom of a decentralized community, in the power of mathematics and code to create something that cannot be destroyed, cannot be corrupted, cannot be controlled. This is why Bitcoin started during a financial crisis, because crisis reveals truth, because crisis creates opportunity, because crisis forces us to question, to imagine, to act, and because in that moment of crisis, someone saw what needed to be done, and they did it. They created Bitcoin, and they gave it to the world, not for profit, not for glory, but as a gift that we are still learning to use, still learning to appreciate, still learning to protect and preserve. A gift that may, if we are wise and fortunate, help us build a better future. And so our journey ends, but the story continues. Somewhere, right now, someone is discovering Bitcoin for the first time. Someone is running a node, validating transactions, securing the network. Someone is mining a block, solving a puzzle, earning a reward. Someone is sending Bitcoin to a friend across the world, instantly, cheaply, without asking permission. Someone is using Bitcoin to escape oppression, to preserve wealth, to participate in the global economy. And someone is questioning, criticizing, pushing Bitcoin to be better, to evolve, to address its limitations. All of these people are part of Bitcoin's story, and you are too, whether you realize it or not. Because Bitcoin has changed the world, has changed the conversation, has changed what is possible, and we are all living in that changed world, navigating its opportunities and challenges, shaping its future with every choice we make. So go forward with knowledge, go forward with awareness, go forward with hope. And remember the lessons of history, the wisdom of the cypherpunks, the vision embedded in that first block. Chancellor on brink of second bailout for banks. A system was failing, and something new was born, something that endures, something that matters. Bitcoin.